Hello, everyone. Yes, very good evening, Hemant. Let us start. So, students, let us first take up your questions. Kindly put across your questions so that we can. Yes, Hemant. You want me to unmute you? I think you can unmute. Please ask your question, Hemant. Hemant, please ask your question.
Yes, sir. See, sir, I have a doubt on this side. See, I have a doubt on when the invoice is to be issued by the recipient for the RCM supply.
Okay.
So there is a circular. I'm
211. 211.
211, correct. So
Okay.
it says that the recipient issues the said invoice after the time of supply.
Mm-hmm.
Where the recipient issues the said invoice after the time of supply, the said supply as said supply pays tax accordingly, he'll be required to pay interest on such delayed payment of tax.
Correct.
Now, again, it says the last line clearly says that that means the invoice has to be generated by the recipient on or before. On should be, because before he will not know what items are getting supplied. So at the time of supply, he should be able to generate the invoice.
Okay. Fine.
Sir,
Can you see
last
my
time,
screen? 1 second. Yes, I've opened the circular. Tell me. So what is your doubt? You tell me.
just 1 minute, sir.
Mithali,
Sir,
can you give the reference where you have read this? Yes, Hemant.
Sir, I have a doubt because last time you said, sir, if that guy, the recipient delays by 2 years, you gave the example, delays by 2 years, he should be able to claim the ITC. But according to this circular, it clearly says the recipient has to issue the invoice at the time of supply. Otherwise, he needs to pay interest, and again he may be also charge the penalty. If you see the 2.6, para 2.6.
Tell me.
So if he says he will be required to pay interest on such delayed payment of tax, because he has declared, he has issued the invoice late, so he has to pay the interest on the
Correct.
delayed payment.
So I agree to that. What is your question?
My question is, sir, last time you said that if he delays by 2 years, still he should be able to claim the RCM, claim the
Correct. So,
ITC.
see, there are two different points. See, when we talk about RCM, understand the uniqueness of RCM.
Yes,
RCM
sir.
is such a transaction where both things happen. One is the levy, that is, you need to pay the tax. So you first step into the shoes of supplier to pay the tax.
Yes.
Second, you step into the shoes of recipient to get the ITC.
Correct.
Now, when two different things are applicable to the same transaction, see, otherwise in normal transaction, what happens? This responsibility is on some other person, that is supplier. This responsibility is on you. You have to only look at the transaction from your perspective, that is the recipient's perspective. But now there are two perspectives, both are applicable to you. One is the supplier's perspective of liability, and second, the recipient's perspective of ITC. Now, in this particular case, we have to apply both the provisions. First is when we talk about the liability of the supplier, that is now under RCM, as a recipient, you have to pay the tax as if you were the supplier. So the time of supply provision applies, means the liability to pay tax is always decided by time of supply. Correct?
Yes, sir.
Now, for RCM transactions, if you remember, we had studied in section 12 and 13 of the CGST Act that there is a specific time of supply provision given, which says that if you're talking about service, maximum by 61st day of the date of receiving any document or the date of making payment, whichever is earlier, correct? Now, if this particular transaction has happened 2 years before, let us say now we are in December 24, this happened in December 22. You made the payment, you got the supply. At that time, you were not knowing about the provision of self-invoice, which is actually the case today also. Many people, especially in outskirts or in smaller parts or the smaller businessmen who do not have the facility or the resources to approach professionals or chartered accountants, they are making this mistake of not preparing a self-invoice for RCM transactions because there is no one to guide them, or they cannot approach any person, knowledgeable person like a chartered accountant who can guide them. Now, in such a case, till today also, why this particular circular is brought, I am giving you the background. Till today also, people may have paid tax under RCM. May. Again, there is again a problem that many people, either by way of ignorance or by way of interpretation of the statute, have not paid tax also on RCM. Now, when this is realized that, okay, this particular liability of tax was 2 years back. Why it was 2 years back? Because time of supply provision is not changing. You did the transaction 2 years back, you made the payment, then the time of supply happened 2 years back, let us say in my example, December 22. But because of ignorance or because of lack of guidance or because of availability of chartered accountants who can guide you in your particular area, that is where this particular circular comes as a relief that no problem. Even today, if you comply with this requirement, which is raising a self-invoice, I will allow you to take ITC. So there are two different things. For taking ITC, you require a document, which is the self-invoice, which we studied in section 16. And for making the payment of tax, you need to report that transaction in your GSTR 3B, plus you need to follow the time of supply. Both these things happened in December 22, but you failed to generate a self-invoice. So this circular is sort of giving you a relief by saying that, okay, you generate self-invoice now and take credit, but this remains the same. Means what? If this transaction happened in December 22 and you did not pay the tax also at that time, so what is happening now in December 24, you want to do both things. No problem, you do both things. You pay the tax also, you take the ITC also. For ITC, this circular says raise self-invoice. In December 24, take the ITC. But the time of supply of this transaction remains in December 22. So from 22 to 24, you will have to pay interest. So what is the disconnect that you are not getting? Or I hope whatever was the confusion is clear now.
Further, sir, if you see the rule 47A, it says that the invoice has to be
47A is simply talking about the time of supply. So that is what I'm saying. The time of supply has already happened in December 22. Correct?
Oh, okay, sir. Okay, sir.
That
Now
is
I
why
understand.
interest. Now, in
Okay.
fact, you have pointed out the correct rule or the correct provision that why you, if your question is why interest, then answer is your rule. If your question is why interest, then the answer is this rule, because as per this rule, time of supply has already happened. You were supposed to raise invoice at that time. So that was the supplier's responsibility you were supposed to do, which you did not do. But still, the circular is providing you a relief. You do it now, you raise the self-invoice, I'll give you ITC.
So
But
that
for
means
the responsibility, you have to pay interest.
So that means that the recipient has to pay the interest and also claim for ITC.
Correct. See, better look at it from different perspective. Let us assume this transaction was not RCM transaction. I am supplier, you are recipient. If I would have paid tax late of this transaction, I was supposed to pay interest, na?
Yes, sir.
And still you are eligible to get ITC because there are two different roles. One is the role of supplier, one is the role of recipient. If supplier does not do his role, he has to pay interest penalty as applicable. Correct?
Right.
And then the second role is of the recipient, that is of taking ITC. Now, these two roles are both put upon you only as a recipient. So you have to play both the roles. For the first role, if you are paying this tax late, so you have to pay interest. And as you rightly pointed out, Rule 47A, in fact, reiterates the same thing, that you should have raised this self-invoice at that time. But still, even if you raise today, no problem. But since you are delaying it, first, delay in payment, you have to pay interest. Again, delay in raising invoice, we may even incur levy penalty on you for not complying with the law.
Understood, sir.
Supplier's role. Fine, beta?
Okay. Yes, this point I understood. So I have a
Beta, your voice is not audible.
So I have a second doubt. It is
Hmm.
talking about subsection 4 of section 16.
Tell me.
Sir, it says that the time limit under section 4 doesn't apply for re-availing of the credit.
Correct.
Because once it has been reversed, so
Hmm.
now if the supplier complies with the rule, the supplier pays the tax, then I can also again re-avail the ITC.
Okay, fine.
Now, there is, I didn't find in the provision, neither in the rule that
What?
that he has to re-avail the credit.
But firstly, did you reverse? What was the reason for reversal? There could be two reasons. One is the 180-day rule. One is the
Yes,
supplier has not paid the tax. Which rule
the
you are talking about?
supplier has not paid the tax.
Then you have to go to section 41. Section 41 is the appropriate section. Section 41 bracket 2 is now
Oh.
providing for this particular point, which says that if supplier has not paid tax, you are now allowed additional time. Yes. No, this is rule 41. See, so section 41, which is the newly amended section, which provides that if supplier has not paid tax, we allow you to still take the credit and you need not reverse it if the supplier pays by the next year September. But if the supplier does not pay by the next year September, then for the time being you reverse this particular ITC taken, and then whenever supplier pays in future, you re-avail it. This is what is provided in section 41 bracket 2,
Yeah.
read with
Okay.
rule 37A.
Okay, that I forgot to see that, sir. Yes.
No problem.
Now I understood now, sir. So the second thing again,
Tell me.
I'm just sending the again another.
Okay, in the meantime, I'll just address Mitali's question. Mitali, you are asking, sir, please explain special purpose vehicle. Mitali, if you remember, I had given example of special purpose vehicles. Special purpose vehicles are the vehicles which are designed for a specific purpose. Like, if you remember, we were discussing one example that within the factory, for carrying goods from one place to another, there are small such vehicles designed where a person can sit, and then there is that particular lever for carrying the goods within the factory. So that is what is a special purpose vehicle. Still you have
Sir,
any
but
particular question? Yeah, tell me.
sir, but in our block credit, if any vehicle is used for transportation of goods, then ITC of that is allowed, na?
Yes, it is exception. It is not covered in
So here special purpose vehicle is we consider that one also when some within a factory, if we use a vehicle to transport one worker from
yeah.
one worker one place to another place.
Yes. But generally, see, that's why I'm saying, depending upon what is the nature. Achha, I'll tell you, I'll give you a very interesting example. You may not have seen factories, but you would have definitely seen in movie, there is that single driven, that automated, that small vehicle where you can stand on it and it is going. Have you seen that in some movie scene?
Yes, sir.
So that is again an example of the special purpose vehicle. I don't know what I should put so that I can show you the image. I don't know the
Right.
exact name, but that is,
Sir,
those vehicles are
I
designed either
understand
for,
that. I
yeah,
also
either they are
imagine
designed
that
for carrying
vehicle
the
about.
passengers, sorry, not passenger, the workers within the factory, like shifting them from one place to another, or mainly these special purpose vehicles are for lifting the goods and putting it in another place. Correct? So that is what is an exception to the definition of motor vehicle. And if any such special purpose vehicle is used within the factory, which is specially designed for being used within, you remember the word uses within enclosed premises. So any such vehicle designed to be used within enclosed premises would be eligible. I'll give you a very interesting example. Have you seen those battery operated vehicles which are to be used like they are used in airports or they are used in resorts for taking people from one place to another? Have you seen those battery operated
Yes, sir. Sometime in a zoo also they use
Yeah,
that.
in a zoo also. Yes, you're right. What is it called? I forgot the name. So I hope you understood what I'm trying to say. Correct, na?
Yes, sir.
So that is eligible, beta. Okay, so the next question, Hemant, that you have put is, could not understand 1661, understood 1662, 1661, 1662. Okay, 166.
That is the cancellation of registration, sir, and revoking of the registration.
Registration cancellation 166.
Oh, that is claiming ITC when you
Acha, ITC
in the-
claiming. Okay.
Yeah.
I'll explain what is this. See,
So that one I didn't understand. The second clause I understood. The clause one I didn't understand.
okay.
It says filed up to 30th of November following the financial year to which such invoice or debit note pertains, or furnishing the relevant annual return, whichever is earlier. This filed means what? I didn't understand the
I'll
first
explain.
word.
I'll explain. See, now we are nearing 31st of December 24. Now people are filing their annual return for the financial year 23-24 now, correct?
Yes, sir.
Now, let us take example. 23-24 is the financial year. Now, for this financial year, whatever credit you have to avail as a recipient, either on the invoices received or either on the debit note received, correct? These you can avail up to 30th of November 2024, which is already gone, or filing of annual return, whichever is earlier. Generally, annual return people file later only. So, in our example, if let us say you are filing the annual return today, so you can avail this credit up to 30th of November 24. Understood?
Correct.
Now, let us say in March, because there was some doubt about your eligibility, or you had not paid few months taxes. So under section 29, the officer Suomoto decided to cancel your registration. So
Yes.
either he cancelled or he for the time being suspended your registration. Now again, in section 30, there is a provision whereby after the officer has cancelled, you can apply for revocation, where you can give him the reasons why your registration should be allowed. You should not be disentitled with the registration. And let us say after complying with all the requirements given in the registration cancellation, like non-payment of tax or wrong availment of ITC, whatever, you comply with all that, you correct all that, and the officer restores your registration, that is, he revokes the cancellation, correct?
Correct.
But all this happens by January 25.
Yeah. Yes.
Now, what will happen since March 25, 24 till
Correct.
January 25, since your registration was cancelled or suspended, you could not file the further returns because that the portal doesn't allow, correct? Correct?
Yes, sir. Yes.
Now, you had to take so many credits either of the earlier periods which were left out or for the month of March itself because the return is not yet filed. Now the point is, if your registration is revived in January 25, you have missed the deadline given in 16.4 of claiming it by 30th of November. Correct?
Yes.
Now this was going against the business because the officer cancelled or suspended the registration, because of which I could not file return. So it was not my mistake that I did not claim it. It was because the portal did not allow me to file. So this 66 is brought, which says that when your registration will be revived, if this happens after this due date by which you are allowed to take the credit, let us say in my example, it happens after 30th November, it is happening in January 25, correct?
Right.
So then you will be allowed 30 days after this revocation happens to file your pending returns and claim whatever balance ITC was there. So to this extent, 16.4 will not apply.
So that is the clause 2. That is, if it's 30 days, within 30 days, that is said, that is written in clause 2. If you look at the clause 1 in the section itself, 16.6.1.
This is what you are saying.
Yes, sir.
What is it saying? Filed up to 30th day of November following the financial year to which such invoice or debit note pertains or furnishing of relevant annual return, whichever is earlier. Yes. So
I didn't understand, sir. What is this?
that was so I'll give you example.
Okay. Right, sir.
Now your registration cancellation is restored. My first example was in January 25, correct?
Correct.
Now, if that is the case, then I'm giving you extra 30 days after that, right?
That part I understood, yes.
But what if your registration is, your revocation is cancelled before the 30th November itself?
Before
Are
the
you getting my
30th
point?
Okay. Before you file the
Annual, before the due date expires.
Before the due date.
Correct. So let us say it was cancelled or it was suspended in March 24, but it was, this cancellation was revoked in October 24 only.
Okay.
Then what will happen? So that is C. I'll read the entire section. Where registration of a registered person is cancelled under 29 and subsequently the cancellation is revoked under 30 or pursuant to order by the appellate authority or tribunal court, and where availment of ITC in respect of any invoice debit note was not restricted under subsection 4 on the date of order of cancellation of registration. Means on that day when your order of cancellation came in March, at that time your time limit was there, so you could have availed if you could have filed the returns. That is what is the meaning of this, was not restricted, correct?
Okay, sir.
The said person shall be entitled to take the input credit in respect of such invoice, debit note, etc., first up to this due date, which is the due date, correct? Now, when this clause 1 will apply, if the revocation has happened in October only, so still the due date is pending.
Okay.
Then you do it by due date only. Then there is no relaxation or no extension of time.
But so there is no relaxation. Okay,
yes,
sir. I understood. So that means in the first case there is no relaxation. If revocation
because not required, na? Not required, na?
Okay.
But still, what they are saying, because they are saying whichever is later, right? So first is, let us say your revocation happens on 25th of October 2024, correct?
Yes.
Now your due date is 30th of November 24. So still the revocation is happening within the due date, right?
Yes.
So first date is the due date, that is 30th of November.
Right.
Second is for the period from the date of cancellation of registration or the effective date of cancellation of registration, as the case may be, till the date of order of revocation, where such return is filed within 30 days from the revocation order, right?
Whichever is later.
So now 25th October is a revocation order. Add 30 days. It will come somewhere on 23rd or 24th of November. So you can still do it by 30th of November, correct? So 30th of November is the last date. But second example, revocation order comes on 25th of November. Okay. Now practically within 5 days.
Yes.
Because now your due date is 30th of November. It may not be possible. So it would be unfair asking you to do it in 5 days. So there, whichever is later will make what? This 30 days rule applicable. Okay. In other words, you should have minimum 30 days to file the pending returns.
Okay. I understood, sir, now. Understood.
Perfect. Understood?
Yes, sir.
Great.
So now, so there is another doubt, sir.
Yes. Tell me.
I am just posting this message.
Please do that. In the meantime, I'll answer Jeannie's question. Sir, can you please explain the ITC reversal regarding return of expired medicines? But see, the answer, we discussed this in the previous class. I'll repeat. So I am the manufacturer, you are the distributor, and let us say Hemant is the retailer. Now I sold goods to you, you further sold to Hemant. Now Hemant has to sell it to customers. But by the time the customers purchase those medicines, certain medicines expired because there is some expiry date printed on that. And legally, then you cannot sell it after the expiry date. So as per the policy of the company, Hemant returns it to you, you return it to me. Now there are two methods which are provided in this. Since it is a sales return for me also and for you also, first method, which is the method originally provided in the law, is of issuing a credit note. But practically the credit note may not be always possible because by the time these medicines are expired, the time limit of issuing credit note, which is again this 30th of November, or annual return, whichever is earlier, may have expired. And now, if the time limit for issuing credit note has expired, in that particular case, legally, logically, you cannot issue the credit note. So they give you the second option also. Second option can be used even if the time limit for credit note has not expired. That is, instead of showing it as sales return, Hemant will show that he has sold the expired medicines to you. You will again sell it to me. So indirectly, it is as good as sales return only, but shown as fresh sales. Now, because of this, what will happen? Whatever you sold to Hemant, Hemant had originally taken credit of that. But now, since this is remaining idle or unsold and now it is expired, he will sell back the medicine to you. So whatever ITC he had taken on the medicine, on the sale, it will get automatically cancelled. Now again, when I had sold to you, you had taken ITC. When you will sell it back to me, automatically whatever ITC you had taken at the time of purchase, now at the time of sale of these expired medicine, that will also get knocked off. That will also be wiped out. So from both of your ends, the credit that you had originally taken on the purchase of these medicines is automatically consumed or wiped out by showing a sale. Now, when these medicines come back to me, you have shown the sale of medicines to me. So you have charged some GST to me, which is now coming to me as ITC. Now, I may take this ITC, but since I have to destroy these medicines compulsorily as per the rule because these are now expired, these will become ineligible under 17(5)(h), and hence I'll have to reverse the ITC. So this is what is the point, beta.
यस
जी।
सर, एक्चुअली वो फ्रेश सप्लाई की वजह से थोड़ा कंफ्यूजन हो गया था.
अभी क्लियर हो गया?
यस सर, यस सर.
Good. Now I go to Hemant's question. Sir, we saw that C2 is the common credit. Then we computed common credit attributable to exempt supply using C2. Then we again said portion of common credit for non-business supply is 5% of C2. We should first deduct common credit for non-business purpose from C2. And then we should find common credit attributable to exempt supply using the figure C2 minus 5% of C2, that is credit attributable to exempt supply, should be D2 is equal to E upon F multiplied by C2 minus 5% of C2 instead of D2. Okay. So non-business purpose, exempt supply and taxable are the three independent. Okay. I understood your query. So what is your question, beta? Hemant? It is, I think, more than a question. It is a pain point. So according to you, because we are not reducing this 5% before applying the formula, then effectively somewhat more reversal happens. This is what you want to say?
Yeah, that means it is not correctly reflecting.
See, beta, firstly, see, normally when we are studying law, we have to, like how I removed my specs, we have to remove the specs of what is right, what is wrong. Because many times, beta, in law, it is very difficult to say what is right, what is wrong. Like I'll give you an example in the same point. They have said that for non-business supplies, you have to consider 5%. I will say this 5% is wrong. Firstly, why this 5% is calculated on the common credit? Why not on the total credit? First point. Second point, I'll say, no, 5% is too much. It should be 1%. Officers say, no, 5% is nothing. You should take 10%. So both of us will say, no, the law is wrong. But that is not correct. See, whenever the law has to be designed, it has to be designed more considering the practical application of the law rather than the theoretical perfection. Theoretically, something else may sound perfect, but if practically that computation is not possible, if that cannot be applied practically, the law will fail. So in such cases, there is no other option with the lawmakers but to keep aside the perfect provision, which is only theoretical, and to take an artificial provision, which will be more practically possible. Now, when this is done, this cannot be challenged by us that it is wrong. We have n number of examples. Like I'll give you another simple example of income tax. In income tax, we have a concept of deemed income. In GST Schedule 1, we have the concept of deemed supply. Now, in both these concepts, they are deeming that some supply has happened, whereas there may be no supply. They are deeming that you have earned some income, or they are deeming some value for the income, but that income may not have been earned. So can we say that just for charging more tax, the law is deeming something, so it is wrong? Answer is no. Definitely, whenever any such provision comes, people take it to the Honorable High Courts and Honorable Supreme Court challenging the constitutional validity. But in majority of the cases, where the lawmaker proves the reason why they brought the deeming fiction, then in 99% of these cases, the constitutional validity challenge fails. And even the Honorable High Courts and Honorable Supreme Court has accepted that the provision is correct. So coming back to your question, why I gave this background, because this may come to your mind for any other provision also. We cannot challenge that, okay, this 5% should be first deducted and on balance you should apply the formula, because anyways 5% what they have considered according to me is very small. If I would have been the lawmaker, now this may not sound very happy to many people, but if I would have been lawmaker, I would have reversed more than 5%, maybe something like 15-20% at least. So I think the lawmakers have been very kind by taking only 5%. But
Okay,
anyways,
understood, sir. Okay,
there's nothing
understood,
right,
sir.
nothing wrong in that, beta. Correct?
Okay, sir. Okay, now I have posted the new question, sir.
Okay. The symbol A is used in Rule 43(1)(c). This I understood as input tax on individual capital goods. Okay. Aggregate of A is referred to as TC in Rule this. The formula TM is TC upon 60. Okay. The common rate of capital goods attributable to exempt supply is determined as TE, which is E upon F into TR. Okay. This I can't understand. See, if you remember, I had explained what is this TR, and I agree to this that they have not defined TR, or somewhere it may be lying somewhere else. But if you remember, I had explained this, that what is this TR? The TR is that I have 10 different capital assets which are falling in this reversal because they are all common capital assets. And these are 10 capital assets have been purchased at different points of time. They are shown in my different account heads. So when I have to calculate that TC upon 60, which is referred to as TM, that is, I am doing it at individual asset level. So it will be done for asset 1, asset 2, asset 3, asset 9, asset 10. Though all of these would be called as TM. So what is TM? TC upon 60, TC upon 60, TC upon 60, TC upon 60 of each of these capital assets. And then adding up all the TMs is the TR.
Okay, sir, but what is this A, sir? I didn't understand A and then TC. A is somewhere in it says that is the aggregation of the TC is the aggregation of A.
But I'll also have to check what is this A.
43(1)(c).
This you are saying? The
Yes,
amount of
yes.
input tax in respect of capital goods not covered in A and B, denoted as A,
Yeah.
shall be credited to the electronic credit ledger,
Yeah,
and the useful life of such asset shall be taken as 5 years. Okay.
Yeah. Now
So I
if
did
you
not
go
get
to
your question.
now if you go to D, same rule D, see the aggregate of amounts of A credited to electronic. So the aggregates of amount of A. So that means I understand that A relates to one capital goods or one capital asset.
Okay, I also understand the same. Tell me now.
So the tier is now confusing. See, for example, if you take A as the input tax for one single capital asset, then TC will be the aggregation of all A's. Down the TC, if you divide by 60, that is what we call now is TM. It is already aggregated. TM has the aggregated figure. Now this tier is very confusing because
let me see. They have put some 12. Clause
yes,
of the rule which contained the provisions of computation has been omitted. This has rendered the formula given G auto-is as the term TR is now nowhere defined in the amended rule. So that's why I'm saying, beta. So in fact, they have amended it because they have also realized that there is some mistake in this TR. So this should have been TM only.
so that then the rule then sir, the T will become now E divided by F into TC. Am I right, sir?
Sorry.
The T should be E divided by F into TM.
So it is TM. Okay, correct.
But in the text it says TR.
So beta, that is a typographical error, na? Anyways, now if
Ah.
you are following the latest GST Council meeting, in fact, the council has agreed that we have a mistake in the section 17.5 also in plant and machinery and plant or machinery. So
Yes,
that may be a typographical mistake. So it's okay.
Okay. So then we'll take TR as TC. Am I right, sir?
Correct.
TR as TM.
TM.
TR as
Correct.
TM.
Correct.
Yeah.
Yes, beta.
Yeah. My doubts are over now, sir.
Okay. Anybody else? Anybody else? Yes, Mitali, Ginny, Rohit, anybody else has any questions or doubts in whatever we have studied in this chapter till now? Okay. So in the previous lecture, we started studying section 18. Section 18, the first part of section 18 deals with the scenario where you are shifting from one category to another or from the other category to first. What is the first category? First category is you are not registered, but you are becoming registered compulsorily or you are getting registered voluntarily. Next is you are registered under composition, now switching to regular, or you are registered and supplying exempted goods or services. Now your goods services have become taxable. So now you are switching from this to this. In this case, first see the first part of section 18 says whatever ITC you did not avail earlier on the goods which are lying in stock, you can avail now. Now, the difference is in these four cases, the first two cases deals with non-registration to registration. Over there, ITC on goods lying as inputs in your stock can only be availed. Whereas in the other two cases, where your composition now switching to regular or you are registered supplying exempt goods, now those goods have become taxable, you will be eligible to avail ITC of inputs as well as capital goods which are lying in your stock. Correct? Then the other part is the reverse side. When you are already registered, now you are becoming unregistered because you are surrendering or cancelling your registration or it has been cancelled by the officer. Or second, you are regular, now you are switching to composition, or till now your goods services were taxable, now they have become exempt because of some notification. Now, in this particular case, again, similar provisions are provided that whatever ITC you had already availed because you are in the taxable category, and if any of the inputs or capital goods are lying in your stock, you have to reverse. For inputs, whatever inputs are lying, entire input ITC has to be reversed. For capital goods, again, the proportionate working, taking 5% per quarter was provided. Now, we move on to the next part in section 18. Now from here, some specific case scenarios are covered in 18. First is amount payable on supply of capital goods or plant machinery on which ITC has been taken. So now what is happening? You are selling your capital goods. So they have used the word supply. I'm using the word selling. So whatever assets or plant machinery I had purchased at the time of purchase, I had taken ITC. Now I am selling those assets. Then what will happen? Then you have to pay GST, which will be higher of the two amounts. Now, what are these two amounts? First, at the time of purchase, you have taken some ITC. Compute the ITC that you can keep with you. How much ITC you can keep with you? That is calculated at 5% per quarter till the time you have used the asset. So let us say I had purchased some capital asset, some plant machinery, which was purchased by me 2.5 years back. Now, since I have used this plant and machinery for 2.5 years, or let us say it is not exactly 2.5 years, it is 2 years and 5 months. Now, even if it is part, it will be considered as full quarter. So even though it is 5 months, we will consider it as 6 months. So how many quarters it becomes? 2 years per year, 4 quarters. So 2 years is 8 quarters. And then half year, that is 6 months, is more 2 quarters. So total 10 quarters. Now, for 10 quarters at the rate of 5%, it comes to 50%. So whatever ITC I taken on this machinery, let us say the ITC taken by me was 20 lakhs. From that, I will reduce this 50% because I have already used this plant machinery for 2.5 years. So 50% I will reduce. So the balance amount, which is now left, becomes my first amount, which is 10 lakhs. So this first amount is 10 lakhs. Second is, since I've sold these capital goods, there would be some tax, there would be some output tax. Compute that output tax. Obviously, it will be computed on the transaction value. That is the price at which I've sold this second-hand machinery. Compute that amount. Now, possibility 1, the amount comes to rupees 9 lakh. So whatever is my sale price of the second-hand machinery multiplied by the percentage, it comes to 9 lakhs. I have to pay whichever is higher. So it will be 10 lakhs. That is the proportionate ITC amount. Second possibility, this amount, that is tax on transaction value, comes to 11.5 lakhs. So then again, I have to pay whichever is higher. So this is 10, this is 11.5. So I will pay 11.5 lakhs. That is what is section 18 bracket 6 read with rule 40 bracket 2 and 44 bracket 6. Further, what it is saying, the ITC which you have to calculate proportionate should be computed separately. This point you will find everywhere. Wherever we are doing this proportionate working, everywhere they are saying you have to compute it for CSI separately. Where the amount of ITC remaining so determined exceeds the tax payable. So as we saw, either the ITC can be more than the tax payable or the tax payable can be more. So they are going by the first scenario that the ITC is more. In such cases, where the amount of ITC so determined exceeds the tax payable on the transaction value, such amounts need to be paid and thus should be added to your output liability. So whatever is higher, either the proportionate ITC or the tax, you will add it to your output liability. So that much amount you will be paying. Most important, if refractory bricks, molds, dies, jigs, and fixtures are sold as scrap, the taxable person may pay tax on transaction value. In other words, for these items, you need not find out the proportionate ITC amount. For these items, you will simply take the sale value at which you have sold them multiplied by the tax rate. Now, there is a star put for this particular point, that is for proportionate calculation of ITC. What it says, under rule 44.6, ITC involved in the remaining useful life in months of the capital goods is reversed on pro rata basis, taking the useful life of 5 years. Okay. Now, clarification on ITC available on demo vehicles in case where such vehicles are capitalized in the books of accounts by the authorized dealer. Now see, this demo vehicle point, if you remember, we had discussed above also. Above where it had come where we were discussing 17.5 blocking, where it was given that if you have purchased any motor vehicle which you are not going to supply further and it is of 13-seater or less, you have to block the credit. Now I am a motor car dealer. Generally, whatever motor cars I have purchased are for further supply, so I am eligible for ITC. But I also purchase one piece of each model, which I will be keeping with myself as a demo car. Now, obviously, this demo car is not kept with me with the intention of further supply. I am keeping it because I want to display it to the customers, whoever want to come for test drive. So there was a question whether it will get blocked or not. Different people had different views. So there was a circular clarifying that don't worry, you can avail the ITC on demo vehicle. Now, again, further what they are clarifying that this demo vehicle in my books of accounts, what will happen? Many times I will capitalize it. I will not show it as, I will not expenses out or show it as my expenses in my P&L. I will capitalize it. Again, the question comes, if you capitalize it, whether it will still affect your ITC eligibility. So they have clarified this again. Since the demo vehicles are used by the authorized dealer to promote further sale of motor vehicles of similar type, and therefore such vehicle appears to be used in the course and furtherance of business. So that is not a problem. Accordingly, availability of ITC on demo vehicle is not affected by the way of capitalization of such vehicle in the books of accounts of the authorized dealer, subject to other provisions. In simple words, whether you show it as your marketing expense and expense out in P&L, like some people may treat this, the cost of demo vehicle, not as an asset, but they may show it in their P&L. So they may treat the cost that they are paying for that demo vehicle as a revenue expense and expensing out. Some people will say, no, this vehicle anyways is costing a good amount. Every year, if I purchase 2 or 3 demo vehicles, it will be going around 40-50 lakhs. And I will be using this demo vehicle for 2-3 years for using it for test drive. So let me capitalize it. So some people may rationally even capitalize it in books. So this particular point clarifies that we are not bothered about whether you expense it out or whether you capitalize it. For us, the answer remains same. So what are the scenarios covered? Where the registered person has claimed depreciation on the tax component of the cost of capital goods and plant and machinery under income tax. In case of capitalization of demo vehicle, availability of ITC would be subject to provisions of 16.3. Now, what is this 16.3 provision? See, if you are capitalizing the demo vehicle, so let us say the car is purchased for 20 lakhs. The GST component, let us say on it comes to rupees, broadly, let us say 5 lakhs. Now, if you have capitalized 25 lakhs, that is 20 lakhs of car plus 5 lakhs of GST, obviously ITC of that 5 lakhs is not allowed, because that is one of the conditions of section 16.3, that in case of capital asset, whenever you are capitalizing and you want to take ITC also, so in such cases, you should not capitalize the GST component. If you capitalize the GST component and are claiming depreciation, then you cannot take the ITC. Same thing is clarified over here also. Second, in case demo vehicle which is capitalized is subsequently sold. Now, this is an interesting case scenario. It may happen that after 2-3 years, now, since I do not require the demo vehicle anymore, now new models have come. Either I will start using it in my business for normal purposes, or I will sell it. Now, if I sell it, what will happen? Then the authorized dealer will have to pay an amount of tax as per the provision that we just discussed. That is, one is the proportionate ITC on the basis of period of use, or GST on the sale value, whichever is higher, that you are going to pay. Is this clear to all? Okay, so no doubts. Let us continue then. Now, section 18.3, it deals with another case scenario. What is this case scenario? Transfer of ITC in case of change in constitution. Now, what is this? Let us first understand. So, the example is, I am running a business. The business is a factory where at the time of purchase of different items, maybe capital goods or maybe stock in trade, I have been availing ITC. Obviously, this is what we do. Now I'm running this factory for past few years, and now I decide to transfer the business as a going concern, right? Yes. So I was saying, now after running this factory for a few years, now I decide to transfer this business as a going concern. Now this I may do by way of a sale of the business, or I may do by way of, this is what they are saying, transfer or change in ownership. This is by way of sale. It may be by way of merger, demerger, amalgamation. So we have so many models of reorganization of business. This is how you refer to this in accounts also and in income tax also. So what I'm doing is I'm selling this business in one of these ways. Now, if I'm selling this as a going concern, now you all understand, being student of accountancy course, what is going concern. So when I'm selling it as a going concern, again, you all know that in GST, sale of business as going concern is exempt. So this is an exempt business and this is an exempt supply, and there is no GST liability on the sale of this business. Now comes the interesting part. I have ITC balance with me because I have been availing ITC over the period, and it is not necessary that my entire ITC gets consumed, especially if I have a lot of capital investment in assets, plant, machinery, etc. The ITC that is coming is huge, and it may not get fully absorbed with my sales. It may get over a period of time, but before that, I decide to sell this business as a going concern. Now, whatever ITC I am having with me, which is lying idle with me now. Why I'm saying idle? Because now, anyways, I'm closing down this business. I'm transferring this business to you. So for me, this ITC is of no use. What can I do of this ITC? So this section 18.3 read with rule 41 says, I can transfer this ITC to you. I will transfer this ITC to you. To you means to the buyer of this business. And this would be done by filling in particular form and by satisfying one very important condition, that when I'm transferring this business as a going concern, I should transfer all assets, all liabilities. It cannot happen that I'm only transferring asset or I'm only transferring few of the items. Then this rule will not apply. See, what is transfer of business as a going concern? I am fixing one single price, and for this single price, I am giving to you the running business. So it is like this. Normally in Hindi say, गल्ले पे आज तक मैं बैठा था, कल से आप बैठो. So कल से गल्ले पे आप बैठने वाले हो. This is what is transfer of business as a going concern. So nothing else is changing, only the owner is changing. तो जैसा वापस हिंदी में मालिक बदला, बाकी कुछ नहीं हुआ, बिजनेस वैसे ही चल रहा है. इनफैक्ट कस्टमर्स को या किसको तो पता भी नहीं चला कि ऊपर ऐसा कुछ हो गया. Like this is happening in case of so many big companies, and we are least bothered. Big Bazaar at one time was somebody else's business. Now it is somebody else's business. And there are so many such examples. Our Indian Airlines, correct? There are so many examples where the business owners change, but we are least bothered because for us the product, the goods, the service is more important. Now, in such cases, it is transfer of business by going concern. Section 18.3 read with rule 41 says, whatever ITC is lying idle with me, that ITC I can transfer further, and for this I have to follow certain procedure of filling up certain form. Now, further there was a circular. Now, why this circular had come? This circular had come to address one very specific scenario where there is a change in ownership, but because of death, and the death is of the sole proprietor. So now you can understand, if there is death of a sole proprietor, by default, the business, if it is still running here despite of the death, obviously who is running? It is the family members. So by default, the ownership of the business gets transferred by way of devolution, by way of operation of succession laws. It will get devolved on the heirs of that particular proprietor. Now, in such cases, to clarify certain procedural issues, this circular was issued. Fine. So what are the points? It is saying change in constitution of the person. Most important, you should also transfer liabilities. As I said, if you're not transferring liabilities, then I will not give you the benefit of transferring the ITC. If all these things happen, then ITC remaining unutilized in the credit ledger will get transferred to the newly constituted entity. Correct? Now, this was the first point. Now, how it will be transferred? That is provided in the rule. The rule says that you have to fill in a form which is called as ITC02. So the transferor of the business will fill in the form, and it will, obviously the form is like, you can say, a way of informing the GST portal that, okay, I with the registration number this is selling the business to you with the registration number this, and this is my stock, this is my capital asset, and this is the balance of ITC. Once I fill in this form, the portal shows this at your end that, okay, this particular GSTN has shown this particular transfer of credit to you. Once you accept it, the ITC, whatever I was having, gets shifted to you, and it starts reflecting in your credit ledger. So in other words, your credit ledger balance increases by that amount. This is what is the procedure. Correct? Now, there is another circular which is clarifying another issue. So this circular is clarifying the issue relating to demerger. Now in demerger, what happens? There is one company which gets split into two companies or more companies. So let us say it is company A, and after demerge, it has become company B and company C. Now, first thing is clear that I will be transferring my ITC to you because I have fulfilled all the above conditions. I have transferred all assets and liabilities, and I can transfer the ITC. But now there is one small practical problem for which this circular is issued. In this case, my business is getting split into two entities, or it is getting divided into two entities. So logically, both the entities should get share in ITC because both are receiving some part of my assets and liabilities. And that is correct. We all have done this in accounts, that in case of demerger, my assets and liabilities are divided between both these entities. That is where it is demerger. Now in such a scenario, the question that comes is, how will I proportionate the ITC balance between the two? So for this, the circular clarifies that you will take the ratio of value of asset. Rather, this is given in the law itself. But the question was, it may happen that I may not have transferred the value, or I may not have transferred the assets which are having ITC in the same ratio. Example. So I have transferred both of you all the assets, but it may happen that to one entity, I may have transferred more of the immobile properties, and to other entity, I may have transferred more of the movable property. Now you all know that for immobile property, there was no ITC. It means whatever ITC balance I am having today, which I have to distribute between both of you, is pertaining to only movable property. Technically, if I have given you, that is out of B and C, you are B, the other person is C. If I have given you, that is company B, all the movable property, and let us say I have given majorly the immobile property to company C, in such a scenario, the question arises that whether I should transfer entire ITC to you and no ITC to company C. Why? Because ITC obviously with me is only on the movable property. For immobile property, there is no ITC except plant and machinery. Now, if I have transferred the mobile properties or the properties which are having this ITC only to you or majorly to you, then still I have to apply the ratio of value of assets, because maybe value wise both are getting same value of asset. But ITC wise, whatever assets I've given to you is mainly carrying the ITC. In such cases, the circular clarifies the value of assets means the value of entire assets of business, irrespective of whether ITC has been availed on these assets or not. So even though in reality, the assets having ITC have been majorly given to you and not to the other entity, but for the purpose of dividing the ITC between you both, the ratio will be the ratio of value of asset, which in my example is equal, even though you have got all the ITC assets. Then the next para is talking about that form ITC02, which I will upload on the portal. Again, if you remember, we had the same point earlier also, and the same condition was there that I will have to take a certificate from a practicing CA or a CMA that the proportion and all the calculations which are required and the conditions which are required have been satisfied. So upon doing this, this particular process will get completed. Then next clarification, which is provided in this circular, is in relation to apportionment of ITC in case of business reorganization. So for the purpose of apportionment of ITC pursuant to demerger, the value of assets of the new units is to be taken at the state level, at the level of distinct person, and not at all India level. The transferor would be required to file ITC02 only in those states where both transferor and transferee are registered. Okay. Now, what is this point? Again, this point is dealing with a scenario where whatever I am transferring, let us say a demerger has happened, correct? Now, I may be having my business in multiple states, and each state, I am, let us say, in 6 major states, I am having my units, and every state the demerger has happened. Now, the value of assets, which is the ratio I have to take, is the value at all India level, or it is the value at the state level. Now you'll say, sir, what is the difference? The difference is at all India level, I have divided my assets to both of you all equally, right? Yes. But at state level, it may happen that a particular state unit is given to company B and nothing is given to C, whereas some other state's unit is given to C and nothing is given to B. Because practically, if it is one single unit, I may not be able to divide it or split it practically because nobody will get anything which is usable. So demerger anyways is happening at company level, that you can understand. But at the GST level, we have registration state-wise. So I had GST registration in 6 different states. Each state was having one unit. Now in this particular case, how this particular ratio has to be applied, there they are saying that maybe at company level, the ratio is equal. But now when you have to divide the ITC, what it said, for the purpose of apportionment of ITC pursuant to demerger, the value of assets of the units is to be taken at state level and not at the national level. So at national level, the ratio is equal. But maybe in state 1, the entire plant is given to company B. So entire ITC of this particular state will be given only to company B. Whereas in state number 2, the plant is given of that state to company C. So entire ITC balance of this particular state will be given to C. Let us say in state 3, there were 2 units. So I gave one unit to each company, but the value of assets of those units is 70-30. So in that state, whatever ITC balance is there, I will give to both the entities in the ratio of 70-30. So this another issue was clarified by this circular. So see, as issues start cropping up, they go to the council for clarification, and council also has experts who analyze the law, analyze the provision, and find out a practical workable solution. So again, I appreciate this particular clarification given relating to demerger, where your business is spread across multiple states and the units which you are now transferring is not in one state, it is in multiple states. Again, the ratio of value of assets shall be applied to the total amount of unutilized ITC. That is the sum total of all these credits. The said formula need not be applied separately in respect of each head of ITC. Further, the said formula shall also be applicable for apportionment of cess between the transferor and transferee. Fine. The total amount of ITC to be transferred to the transferee, that is the sum of all these, should not exceed the amount of ITC to be transferred. So the total amount which is I am having in my ITC ledger, only that can be transferred to both of you. So whatever I have transferred to each one of you, the total should match with the ITC ledger balance with me. However, the transferor shall be at liberty to determine the amount to be transferred under each head within this total amount, subject to the ITC balance available with the transferor under the each head. So what does first 2 points said? The first 2 points said that I will be computing this proportionate amount which I have to give to company B and company C, and this proportionate amount will be computed at total means of C plus S plus I balance. So that I need not do C plus S plus I separately. So whatever is my total credit balance of C plus S plus I, for the entire credit balance, I will apply the ratio of value of assets. Now that ratio gave me that 100 should go to B and 80 should go to C. Now when I'm actually giving this 100 to B and 80 to C, obviously I will be giving it from the balance which I'm actually having in my C plus S plus I. It is not necessary that I should utilize each balance in the ratio of 180. So maybe I can give entire IGST up to 100 to company B and C plus S up to 80 to company C. Or I can give C plus S to companies company B and IGST to B, or in any ratio. So what they have clarified in point 3, firstly in point 2 and 1, they have clarified that the proportion calculation has to be done for all 3, C plus S plus I plus whatever ITC you have total. And you got the amount of ITC to be given to each of the transferee companies. Now, while giving, obviously you will be utilizing the actual credit ledger balance that you are having in C, in S, in I. At that point of time, while utilizing the balance, you can utilize it as per your choice. It means it is not necessary that you will give each ITC, that is C, S, I, in the same ratio. The transferor shall be at liberty to determine the amount to be transferred under each tax head within the total amount subject to the ITC balance available under each head. I hope this point is clear to everyone. Further, the apportionment formula shall be applied on the ITC balance of the transferor as available in the electronic ledger on the date of filing of ITC 02, obviously. So whatever balance I am having in my ITC 02, for that balance, this formula has to be applied. For the purpose of apportionment of ITC, the ratio of the value of assets should be taken as on the appointed date of merger as specified in the respective scheme of demerger. So what, see, both points you may find as conflicting. There is no conflict. Here they have said that take the balance on the date of filing of form ITC 02. Here they are saying take the value as on the date of demerger. Now there will be a difference. The date of demerger is the date of signing of that particular MOU between you and the new company. That may have happened in the month of August. But after that, completing all the formalities, it may have taken December. So 4-5 months have gone, by the time all these formalities are done, and now formally you are handing over everything to B and C. And today you are filing the ITC 02. Now in this particular case, there are two questions. First, we have to transfer the ITC. We have to transfer the ITC balance which is available in my credit ledger as on which date? We signed MOU in the month of August, but from August till date, the business is working. If the business is working, the ITC balance is getting consumed, it is getting added, depending upon what has happened in these past few months. So they have clarified the ITC amount which has to be distributed between you two will be as on today. That is the date when I'm filing the ITC 02. ITC 02 is the concluding part, because with this, my balance of credit ledger will also get transferred. So effectively, my balances will become zero. Similarly, the second point is, that is point number 5, I have to distribute this ITC between you all in the ratio of value of assets. Value of asset will be taken off which date? Which is date of demerger, which is August. Because again, from August till date, some new assets may have added, some changes may have done by respective companies, because after I give you all your assets, you will decide what you want to do. You may add more machines, you may sell off some machines which you feel are not fitting your requirement. So the point is, today we are filing ITC 02. Credit ledger balance we'll see today, because this is the balance which I have to distribute. But for this, the ratio which we have to take is the ratio of assets. That ratio I will be taking as on the date of demerger. I hope this is clear and there is no confusion with this. And it is again a very logical point which I feel that why they have given two separate dates.
Excuse me, sir.
Yes, beta, tell me.
सर यहाँ पे हमने ये इसमें लिखा हुआ है ना GST ITC 02 डेट ऑफ फाइलिंग के टाइम पे हम लोगों को जो भी अवेलेबल होगा उसको देखना है, राइट?
करेक्ट.
सर इफ अगर ये मैं फाइलिंग कर रही हूँ वो मिड मंथ में कर रही हूँ, राइट? तो कुछ इनपुट्स अभी जो ऐसे हैं जो मैंने क्लेम नहीं किए, क्या वो न्यू कंपनी क्लेम कर सकती है या पहले इसी कंपनी को क्लेम करना पड़ेगा फिर ITC
दैट डिपेंड्स अपॉन कि आपका वो इनवॉइस किसके नाम से आ रहा है. सी, ये जो 5-6 महीने लगते हैं, ये क्यों लगते हैं? क्योंकि आपकी फॉर्मेलिटी शुरू होती है द डेट व्हेन यू साइन MOU. सो फॉर्मली वी डिसाइड कि यस, हमने हमारे बोर्ड ऑफ डायरेक्टर्स मीटिंग में, हमारे शेयर होल्डर मीटिंग में डिसीजन ले लिया है, उसके बाकी सारे लीगल फॉर्मेलिटीज कंप्लीट कर लिए. दैट इज व्हेन वी आर साइनिंग द MOU. और उसके बाद एक्चुअली जब एक एक चीज हैंड ओवर होना शुरू होगा, सी, हैंडिंग ओवर मीन्स नाउ आई विल गिव इट टू यू, यू विल कम एंड टेक द पोजेशन. आप वहां पे जाओगे, आप सब देखोगे ठीक है या नहीं, मे बी यू विल डू सम ट्रायल टेस्टिंग एंड रन. इसमें ये 5-6 महीने लग जाते. प्लस उसके बाद सारे डॉक्यूमेंटेशन, जैसे सारे प्रॉपर्टी पेपर्स पे मेरे नाम से आपका नाम आएगा. सो जो जहां पे भी डॉक्यूमेंटेशन था, लाइक पुराने कॉन्ट्रैक्ट्स है, वहां पे आपका नाम डालना है. सो वी रिवाइज दोस कॉन्ट्रैक्ट्स. इन सब फॉर्मेलिटीज को 5 महीने लग गए. अब इस 5 महीने के पीरियड में वी आर ऑल्सो इन्फॉर्मिंग ऑल अवर सप्लायर्स कि भाई हमने ऐसा ऐसा डीमर्जर कर लिया है. So you have to now start raising invoice on the new company. Again, we give them the date कि किस डेट के बाद से इनवॉइस आपको न्यू कंपनी पे रेस करना है. सो प्रैक्टिकली कोई भी कंपनी ऐसे बीच में से अचानक से ये सब नहीं करेगा. अगर मैंने कट ऑफ दिसंबर, तो मेरे सारे सप्लायर्स मुझे 31st ऑफ दिसंबर तक ओल्ड कंपनी के नाम से इनवॉइस देने वाले. सो देन आई विल वेट टिल 31st ऑफ दिसंबर एंड ओनली आफ्टर दैट आई विल फाइल ITC 02. और दैट इज आफ्टर फाइलिंग द दिसंबर रिटर्न. क्योंकि रिटर्न फाइल करने के बाद जो वो मेरे क्रेडिट लेजर में आ जाएगा, उसके बाद आई विल फाइल ITC 0. करेक्ट?
यस सर.
सो मे बी 1 जनवरी से आपने बिजनेस अपने नाम से शुरू कर दिया है, 1 जनवरी के आगे से सारे इनवॉइसेस आपको आने लगे. मगर मैं मेरा ITC 02 फाइल करूंगा मेरे दिसंबर तक के सारे रिटर्न्स अपलोड करने के बाद, सो दैट मेरे पास जितना भी क्रेडिट आना था वो पूरा आ जाए, सारा क्रेडिट मेरा पूरा क्लियर हो जाए. मे बी मैंने उसका ऑडिट भी करवा लूंगा. एवरीथिंग आई विल गेट इट चेक फर्स्ट and then I will transfer it to you. Correct?
So there is no limit, last date of filing this one.
There is. ITC 02 फाइल करने का डेट दिया है 30 डेज, सो वो आपको वो 30 डेज के अंदर ही करना है, करेक्ट?
Okay, sir.
आप
Okay.
उसको बहुत टाइम तक पेंडिंग नहीं रख सकते, बट दैट इज सफिशिएंट ना, मैं सब कुछ क्लोज करके देन विद इन 30 डेज आई विल डू दैट, करेक्ट?
Yes, sir.
Perfect. Just give me a minute. Okay. Now we come to a very interesting provision, Rule 41A. What is this 41A dealing with? Let us understand. Now, it is also something like what we studied just above. That is why they have used the word 41A, because it is similar to the above provision. But what is this 41A used for, or where it is used? Now, in above case, what we were discussing till now, that is section 18.3, read with Rule 41. The case was when assessee A is selling the business to assessee B. So there are two separate persons, two legally different persons, correct? But then you have this provision 41A, when legally I am only one person, I am Vishal Poddar, but I am having multiple GSTIN, which in the eyes of GST law is a distinct person. So I'm one legal entity, but I'm multiple GSTIN, so multiple distinct persons, but only for the purpose of GST. I hope this is clear. Now, in this particular case, why this rule was introduced, let us first understand the background. Originally, when the GST law started on 1st of July 2017, the law said that if you are having your businesses in different states, you'll have to compulsorily register in different states. So state-wise, there was a compulsion to take a separate GST number. However, if in the same state you have multiple place of business, you cannot take separate registration for each of these place of business if the business is same, that is, it is the same business vertical. So I'll give you an example to explain. So I am running my CA profession, my CA office, and I am having my place in Maharashtra. But in Maharashtra, I am having place, let us assume, at 4 places: Mumbai, Nashik, Pune, Aurangabad. Plus, I have, let us say, my offices in Gujarat, one in Delhi, one in Tamil Nadu, and one in Kolkata. So within state, I'm having at 4 places in Maharashtra, and outside state, I'm having in 4 more states. Okay. GST law came. I took one registration for Maharashtra covering all these 4 offices: Mumbai, Nashik, Pune, Aurangabad, because that was the rule. Since my line of business is same, my same vertical is going on in all the places, I was required to take single registration within the state, showing one of the offices as principal and the other as additional. I did that. And then I took separate registration, second one for Delhi, third one for Tamil Nadu, fourth one for Kolkata, fifth one for Gujarat. Those anyways, I had to take separate, I had taken separate. Then came an amendment in the GST law, which allowed me to take separate registrations even for the same businesses within the state. So before this amendment, if I had same business within the state, even though at multiple places, I was compulsorily required to take a single registration. Yes, within the state, I was allowed to take multiple registration, but that came with a condition that these should be different business verticals. In simple words, different businesses. But my business is same. It is same CA practice. It is same legal and consultancy practice. So it was not a separate business vertical. So within Maharashtra, for all these places, I had taken one number, which was compulsion. Now, when this particular provision got amended and they allowed me to take separate registrations in Maharashtra, and I wanted to take separate registration, so I decided to take separate for Mumbai, for Pune, for Nashik, and for Aurangabad. So I had one number where I had shown Mumbai as the principal place. So that number I kept for Mumbai, and I took three separate numbers for other three places of Pune, Nashik, and Aurangabad. So now within Maharashtra, I have four numbers. Now, when I did this, that is after this amendment, when I split one registration of Maharashtra into four. So till now, I had only one number in Maharashtra with the other three places as addition. So Mumbai was my principal and the other three were additional. This is how I was operating from the beginning. After amendment, I decided to go for this option, which is now allowed, that I took separate numbers for Pune, Mumbai, sorry, not Mumbai, Pune, Nashik, and Aurangabad. And the number which I originally had, I continued for Mumbai. Now, when I did this, a challenge came, or not a challenge, I'll say a situation came whereby my entire ITC for entire Maharashtra, which included all the four places, is now only in Mumbai because that was the original number. But I have now taken separate registration for the separate three branches. So logically, this ITC, which I had taken at the start, or I've been taking right from day one of GST, is common for all places. But today it was appearing only in Mumbai, and there was zero ITC balance for the other three because they are newly registered now. Now this created a situation where my entire ITC of all four places is in Mumbai, and I am not having any balance in other places. Now, I want to take balance in each of these places. Then Rule 41A was implemented to allow me to transfer the balance from the Mumbai registration to the other three registrations. So it is something similar to demerger, but actually it is not demerger in the real sense, because demerger is when one company becomes two different companies. Here the company is same, but within the company, the single registration of Maharashtra, you can say, got demerged and it became four registrations. So it is similar to demerger in that sense. Now in this particular case, when I have to claim the ITC in other three registrations, I will apply Rule 41A. And 41A is not making any compulsion. It is not saying I have to compulsorily transfer. It is saying if I want, I can transfer. Then the question comes, how to transfer, in what ratio you have to transfer. They have applied the similar logic what we studied above, that when one single registration became four registration, I have to find out the value of asset in all these branches, and in the ratio of the value of asset, I will divide the ITC balance. So what it says, section 25, now this is the amended section, enables a taxpayer to obtain separate registrations for multiple places of business within the same state. So earlier it was not allowed. Later on, after amendment, this is allowed. Now the registered person called as transferor, here transferor is Mumbai, having separate registration for multiple places within the state, which are now Pune, Nashik, Aurangabad, can transfer. So Mumbai can, it is not saying should. So it is an option. I can still continue the entire ITC balance in Mumbai and zero opening balance in these three. In future, whatever each one will buy, they will get the ITC, but the opening will be zero. This is also I can do, or I can transfer it to all three. So what it is saying, can transfer the unutilized ITC. So first it can transfer. Second, I may transfer wholly or partly. So it is not necessary if Mumbai is having balance of 10 lakhs, it has to transfer entire 10 lakhs. Mumbai may decide to transfer only 2 lakhs, only 3 lakhs. So that is also a choice. Lying in the electronic credit ledger to any or all of the newly registered places. So again, here also I have choice. I may transfer balance only to Pune and nothing to Nashik, Aurangabad. I may transfer to Pune and Nashik and nothing to Aurangabad, and so on. But wherever I want to transfer, it is saying in the ratio of value of assets held by them at the time of registration. So if I decide to transfer between Pune and Nashik and not to Aurangabad, okay. But then for distributing it between Pune and Nashik, I have to take the value of asset in Pune and Nashik. So out of 10 lakhs of credit with Mumbai, Mumbai decides to transfer 2 lakhs. So it is not deciding to transfer entirely, that is allowed. So 2 lakhs it can transfer, and when 2 lakhs it wants to transfer between the two, how it will be transferring? It will be taking the value of assets of these two branches, that is Pune branch and Nashik branch, and in the ratio of the value of assets, it will distribute this ITC, irrespective of whether the ITC has been availed thereon. It means again the same logic. So whatever assets I have given to Mumbai, to Pune and to Nashik, those assets may or may not have ITC, makes no difference. So let us say Mumbai has all the movable items and Pune and Nashik has the immobile item. Still, if I want to distribute credit to Pune and Nashik, it will go in the ratio of value of assets, which will be majorly the immobile properties, that is the offices and the buildings. That is allowed. Now, how this will be done? The registered person should furnish the prescribed details on the common portal within a period of 30 days from obtaining such separate registration. Upon acceptance of such details by the newly registered person on the common portal, the unutilized ITC gets credited to their electronic credit ledger balance. So this is very similar to the above procedure given in ITC 02. So this is all about section 18 read with the respective rules. Anybody has any questions? Students, anybody has any questions?
Sir, there is transfer possible between only on existing business, right? For not
Means
new.
what, beta?
सर आप हमारे एग्जांपल में हमारे पास 4 डिफरेंट ब्रांचेस ऑलरेडी थी, तब हमने आईटीसी
ठीक है।
ट्रांसफर किया। इफ
Correct.
अगर मैं 4 की बजाय अब 5 कर लेती हूँ इन अ केस न्यू,
So you start a new branch. Let us say you start this new branch in Navi Mumbai. Correct. After नहीं तो आप उसको नहीं ट्रांसफर करोगे क्योंकि आपके पास जो कॉमन आईटीसी पड़ा है बॉम्बे ब्रांच में, दैट इज नॉट ऑफ नवी मुंबई, क्योंकि नवी मुंबई पहले था ही नहीं। करेक्ट।
ओके सर।
तो नवी मुंबई अगर आप न्यू स्टार्ट कर रहे हो तो आप बॉम्बे ब्रांच का कोई भी क्रेडिट नवी मुंबई को ट्रांसफर नहीं करोगे। आपका बिजनेस वही है, ब्रांचेस वही है, सिर्फ रजिस्ट्रेशन आपने उसको नया लिया है, बिकॉज नाउ दैट ऑप्शन इज अलाउड। करेक्ट। पर अगर ब्रांच ही नया चालू किया यानी बिजनेस ही नया है यानी प्लेस ऑफ बिजनेस नया है, तो ये रूल आपको उसमें अलाउ नहीं करता है। द रूल इज नॉट मेड टू ट्रांसफर टू न्यू प्लेस ऑफ बिजनेस। So the place of business is old, only the registration taken is new. Correct?
यस सर।
सी उसका एक लॉजिक भी कहां से आता है, उन्होंने बोला आपको ट्रांसफर किस रेशियो में करना है, इन द रेशियो ऑफ वैल्यू ऑफ एसेट हेल्ड बाय देम एट द डेट ऑफ रजिस्ट्रेशन। अब जो आप बाद में स्टार्ट कर रहे हो ब्रांच, वो तो एट द डेट ऑफ रजिस्ट्रेशन है नहीं। सो एट द डेट ऑफ अगर रजिस्ट्रेशन और नया ब्रांच नहीं है तो उसको क्रेडिट कैसे मिलेगा? करेक्ट
सर, एट द डेट ऑफ रजिस्ट्रेशन ये हम लोग जब न्यू रजिस्ट्रेशन ले रहे हैं तब की बात कर रहे हैं या पुराने की बात हो रही
ना
है?
बेटा, पुराना तो ऑलरेडी एक रजिस्ट्रेशन में चारों दिख रहे हैं ना।
तो
ये तो आपने 1 जुलाई को ले लिया, 1 जुलाई 2017 को। आप न्यू
राइट
रजिस्ट्रेशन कब ले रहे हो? आज।
राइट।
तो न्यू रजिस्ट्रेशन का डेट आज का है। अब आज तो आपका वो नवी मुंबई वाला ब्रांच नहीं है, 5वां ब्रांच तो आप बाद में शुरू करने वाले हो ना।
ओके सर।
करेक्ट ना। सो जो ब्रांच है ही नहीं, आप उसको कैसे आईटीसी दोगे? और लॉजिकली देना भी नहीं चाहिए, क्योंकि आपके पास मुंबई के पास जो भी क्रेडिट पड़ा है वो इन 3 ब्रांचेस का ही पड़ा है। क्योंकि हमने अब तक जब बिजनेस किया एक रजिस्ट्रेशन लेके, तो जो भी परचेजेस हर ब्रांच में हो रहे थे उसका आईटीसी एक ही जगह पे आ रहा था, और आज वो एक नंबर मुंबई के पास है। तो लॉजिकली भी मुंबई के पास ही अब तक आया हुआ सारा क्रेडिट पड़ा है। सो मुंबई हमें हमें मतलब इन बाकी 3 ब्रांचेस को क्रेडिट डिवाइड करेगा, पर वो चौथी नई ब्रांच को नहीं करेगा, क्योंकि नई ब्रांच अगर बाद में बनी तो उसका कोई क्रेडिट मुंबई में आके पड़ा ही नहीं है। करेक्ट ना।
Yes, sir.
बराबर ना? अभी भी कुछ कंफ्यूजन है? यस मिताली बेटा,
No,
कोई
sir.
कंफ्यूजन है अभी भी?
No, sir. Clear now.
Good. Anybody else has a confusion? Or anybody else has any questions on the points that we have discussed till now? Great. तो यहाँ पे आके हमारा पूरा इनपुट टैक्स क्रेडिट 16, 17, 18 तीनों सेक्शंस कंप्लीट हो जाते हैं. इन शॉर्ट इनपुट टैक्स क्रेडिट का चैप्टर एज गुड एज कंप्लीट हो जाता है. And we start with a new chapter, new topic, that is input service distributor ISD, right? But since we are starting a new chapter as good as, so let us now take our break now and we will start this afresh after the break. So let us take a break. It is now 7:32. We start at 7:45. ठीक है? Okay. This next chapter, even though it is part of the same subject, same chapter, is on input service distributor. Now let us first understand what this concept is, what is the background of this concept, and then we'll go to what does the provision says. Also, just to inform you, till date, as on date, the provision is not compulsory. However, now already notifications have been passed which say that from 1st April 2025, this provision will be compulsory. Now, what is the whole concept? What is the background? Let us first understand. So, as you can see, the name is input service distributor. I will just add one word so that you can understand and remember this. I will call it as input service credit distributor. Now, what do I mean by input service credit distributor? To understand this, let me give you a background. So this concept has come from the excise era. Now in excise, if you had your company, or not company means the manufacturing unit, in different states or different places, like as I gave a previous example when I was explaining you demerger, that let us say I'm one single company having my plants in 6 different states. Now, as per the excise requirement, I had to take registration for each factory separately. So I took 6 registrations under excise, though they were all same registration numbers because I am same company, same PAN, with slight difference. So it is similar to your present GST's multiple registration concept state-wise. Now I had 6 registrations, and all these 6 units which are in different states, I was managing from my central head office, which is in Mumbai. So Mumbai becomes my corporate office, which is earlier it was in Fort area, today it is in BKC. And I have my plants in 6 different places. And if you all know, during the excise regime, many states were having beneficial schemes for the backward areas. So depending upon the beneficial state, I was starting my unit in those backward states or backward regions to get the different state schemes benefit. Now, in excise, this concept came up with the same name, input service distributor, for this particular head office which I'm having in Mumbai. In excise, I was not required to take any registration for this office in Mumbai because I was not going to make any outward supply. In that case, it was removal because there was no manufacturing at the Mumbai. It was only a corporate office or a back office. However, I still took registration for the Mumbai office because many invoices of common expenses like consultants invoice, your legal advice invoice, your marketing invoice, all these are your common expenses. These came in the name of the company. And since it came in the name of the company, obviously it will not come to any of the plants because it is a common expense of the entire company. So it came to me means the Mumbai office, and the opposite persons have charged service tax on that. Now I was eligible to take credit of that, which is called as, or which was called as SENVAT credit. But the problem was my Mumbai office did not have any outward sales or removal which was leviable to excise. So this SENVAT credit, which was kept in my Mumbai office, was remaining idle, unutilized, because there was no outward supply from Mumbai. Then the provisions of input service distributor were brought into the law in the SENVAT credit rules, which provided, or which asked me to take a specific registration for this Mumbai called as input service distributor. So it is like a status, it is a specific registration. So when you go to the portal for taking registration now under GST, you have different options, that whether you want to register as a composition dealer or as a casual taxable person dealer, as a regular dealer, or even as a ISD. So I tick accordingly. So similarly, I was supposed to take a similar type of registration even during the excise era, where I took this registration called as ISD. Now, whatever bills were coming to my corporate office, which is Mumbai, entire SENVAT credit was coming in my Mumbai registration. And this SENVAT credit, since it was not utilizable, it was of no use to Mumbai, but it could be utilized if it was with different units. So what I did was I took this credit every month which was coming and I started dividing it to each of the units. That is what is the ideology of input service distributor. I've added a word input service credit distributor because basically what this head office is doing by becoming ISD, ISD is the short form of input service distributor. We call it as ISD in short. So what is the purpose of this Mumbai office? That whatever input services it is receiving and it is getting the credit of service tax charged by the suppliers, which is called as Senvat credit. This credit is lying idle with Mumbai office. So let Mumbai office distribute the credit to each of its units, and those units which are making outward supply in the form of manufacturing and removal from their units, they are leviable to excise. They will utilize this Senvat credit. The same ideology continued and is carried forward to GST. Now in GST also same thing happens. What happens? I am having multiple registrations and I'm also having a corporate office or a head office. Now same scenario may happen that this corporate office or head office may or may not be having any outward supply. So I may not be having any taxable outward supply, any output tax, but I am receiving again the same common expenses bills on which my suppliers are charging GST, for which the credit is coming and sitting in my credit ledger of this head office. So again, the same provisions of ISD made over here allows me to distribute this credit to all my GSTN, all my distinct persons, so that they can utilize it whenever they are discharging their output liability. This is the basic ideology of this entire concept. Now, the questions that will come ki how will I divide the credit? How will I do the procedural part? How will I find out how much proportion to be given to each of my distinct persons? The answers are provided in this provisions itself. Firstly, what it says, you have to divide it to all your units in the ratio of their respective turnovers. So whatever turnover they are having, because see, you have to divide this every month because every month you are getting credit. So you have to divide it every month. So it is saying take the turnover as the ratio and divide it to all the units. Now again, it may not be all unit. If a particular credit is applicable to a particular unit only, like I was supposed to do cost audit of only one unit, or I had received some notice for which I had to file writ petition and the writ petition was pertaining only to one unit because the notice or the order is pertaining to that one unit. And for filing the writ petition, I took services of a lawyer. So in that case, I know that this credit is attributable only to that unit. Then I will divide or transfer the entire credit to that unit. But if it is a common expense, which is common for all or common for 2 or 3 units, then I will divide the expense taking the ratio of turnover of those units. How will I divide? I will raise an invoice. So the document is invoice only. You can call it as invoice. And in invoice, I will show the amount which is to be transferred to each one of you all. And I will upload this invoice in my GST returns. I do not have GSTR 1. I have GSTR 6. I will upload there. It will appear in your 2A 2B. Like how a supplier uploads his outward supply, it appears in your 2A 2B, and on that basis you take credit. Here, when I upload in my GSTR 6, it will also appear in your 2A 2B, and you will be eligible to take the credit. This is in short, in nutshell, the entire ISD provisions. Anybody wants to ask anything up to this stage, you can ask, and then we'll go to all these points in detail. So here they have started explaining why you require this provision. It is again, as I said, mainly where you have head office, which is incurring expenses by procuring certain services, and the head office may not be able to utilize the ITC that it is getting, and it is getting accumulated for all these input services. So since this common expenditure is meant for business of all units, it is but natural that the rate of input service in respect of such common invoices should be apportioned. And for this, we have this ISD mechanism, which enables proportionate distribution of rate of input service amongst all the consuming units. The concept of ISD under GST is a legacy carried from the previous regime, that is the service tax and excise regime. It is important to note that ISD mechanism is meant only for distributing the rate of common invoices pertaining to input services and not goods. Now, this is, I believe, a small lacuna. Since we copy pasted this provision from the excise service tax era, and in this particular case, the head office was receiving only input services on which service tax was leviable. So this particular provision was copy pasted from excise era with that particular thing in mind, because if the head office is buying any goods, let us say it is buying stationery, computers, what was levied on that was VAT. And in excise and service tax, you are not eligible to get the credit of VAT. So from the excise and service tax perspective, you are eligible to take credit only of the service tax levied on the input services. And that is how the provisions were designed in excise era. However, when we migrated to GST, now the head office, when it is buying any inputs like stationery or day-to-day items required in the office, or it is buying any capital goods like computer systems or some furniture, for all those items, it is eligible to take ITC. And all these items are coming with GST invoice only. Now, logically, I believe here they should have included goods when they brought this concept in GST. However, maybe over a period of time, we may find that this particular thing happens. But as on date, ISD can distribute the credit only for common services, not for any goods. So today for goods also you may be getting ITC, rather not maybe you are getting ITC because you are suppliers of goods like office stationery, office consumables. There are so many items, computer systems, etc., printers, printer ribbons, inks, so many things. But this ISD cannot divide or distribute the ITC received on goods. Now, first point is you need to take a separate registration. And this registration should be ISD registration. See, when you go on the portal to make application for registration, you get multiple options. You have to correctly select the ISD option. This is an interesting question. Can a company have multiple ISDs? A very interesting point. When we see the definition of input service distributor, nowhere in the definition they have used the word head office. But everywhere you see whatever we studied here also and whatever I was explaining, I was giving practical example of a head office only. Because again, in the service tax excise era, this problem happened with head office only, because every unit which was running, whatever input services it was receiving, there was no problem because it was able to utilize the ITC, and ITC means the send back rate, and set it off. The problem was only with the credit which was there with the head office, because head office did not have any outward supply. Now, we all are using the term head office, but nowhere in the law they have used the word head office. So the word used in the law is any office of the service provider, etc. That we'll study the definition. Now the point is, can I have more than one ISDs? Answer is yes. Now we'll ask, sir, how it is possible? See, the point is, why ISD is there? ISD is there so that if there is any common input service, the ITC of that should be divided to all, or should be divided to those units for which the common expense has been incurred. Now, it may happen that, like in my example, I have 6 different units in 6 different states and head office in Mumbai. In that particular case, generally all common expenses will come at Mumbai head office only. So Mumbai head office is by default going to be ISD. But it may happen that out of these units, 1 or 2 units are also receiving invoices for such input services, which is utilized by other units also. There is a possibility. See, in business, there could be different possibilities. Now, in this particular case, if any of these units are receiving common input services, then for them also, and now since it is becoming compulsory from 1st April 2025, now I'll use the word for them, it is compulsory to take a separate ISG number for that unit. So that unit will have two numbers. One is the regular number for their regular operation, and one is the ISG number, so that whatever common expenses those units are receiving, that they can divide to the other units. Rather, they will have to divide from 1st April 2025. So first answer is yes, you can have multiple ISGs, and now from 1st April, I'll say you will have to have multiple ISGs if different other GSTINs are also receiving common input services. Now, how to distribute the credit? For this, section 20 read with the relevant root says that ISG is required to maintain arithmetical accuracy and ensure that the credit distributed does not exceed the credit available. Fine. Further, in distributing the credit among different locations of the entity which are supplying goods and services and having same PAN. So all these entities are within the same PAN. Only to them you can use ISG. You cannot distribute your common expenses to units which are outside your PAN. So that is not possible. That cannot be done. Now, how I will divide this? So certain principles or rules have been given. First, the credit connected to an input service must be distributed only to the particular recipient to whom the input service is attributable. So it is not necessary that every credit will be divided to every other unit. We have to see that that expense is common to how many units, and only to those units the ITC of that expense has to be distributed. Second, if input service is attributable to more than one recipient, the relevant ITC is distributed only to those recipients to whom this common service is attributable, and it is to be distributed in the ratio of the recipient's turnover. So whoever is the recipient, you have to check the respective state's turnover, and in the ratio of turnover, you will divide that particular month's common credit ITC. ITC pertaining to input service which are common for all units is distributed to all units. Most important, ineligible and eligible, both ITCs are distributed, and they are distributed separately. So interestingly, now see, if I'm ISG, that is, I am the head office, I am receiving what you are saying, common bills. Now these common bills may also include bills for food expenses, which is blocked. I may have purchased any of those services which are in 17.5 list, on which ITC is not eligible. But since as a ISD, I cannot do anything of any balance in my books. So what I will do is, I will first get the invoice. All invoices are coming in my name, and I will distribute all invoices, whether it is having eligible ITC or ineligible ITC. So every month I will be raising two invoice on every recipient, one for eligible ITC, one for the blocked ITC, which is ineligible. Next, ITC of CSI are to be distributed separately. So I will raise two invoice for every recipient, one for eligible ITC, one for ineligible ITC. And whatever ITC I am transferring, I will show the C amount, S amount, I amount separately. So I cannot distribute a common ITC, because when I'm distributing credit, it will go from my credit ledger to your credit ledger. So it should match as to the nature of credit, whether it is C credit, S credit, I credit. Now here there is one very important point that we will discuss when it comes further, but I'll just explain because we are on that point. Let us say as an ISD, I have received CS credit also because I have made some intrastate services I have received, and also I have some IGST credit also because I have received some interstate services. Now for interstate services, I have received IGST. For within the state services, I have received C plus S. So I have today three credit balances, C, S, and I. Now when I have to distribute it to all my units, importantly, if the unit to whom I have to distribute the credit is in my state only, then I will distribute C, S, I, all three by the three names. But if the unit to whom I have to distribute the credit is outside my state, I cannot distribute them CS of my state, because I'm sure you all would be knowing that if you are receiving C plus S credit of any other state, you are not allowed to take the ITC. That ITC will get blocked, will be ineligible ITC, and you will not be able to utilize it. Now, if I am having C plus S credit of my state, let us my state is Maharashtra because head office is Mumbai, and you are a unit in Gujarat, another person is a unit in MP, another person is a unit in Jammu and Kashmir, another person is a unit in Uttar Pradesh. Now, if I am distributing my C plus S credit as C plus S credit to y'all, you will never get the ITC for that. So we will study that as it comes further. If I am distributing the credit to outsider, outsider means my unit in some other state, even though I have CS credit, and as per this point, I have to distribute all these credit separately. But when I'm distributing this credit to an outside unit, I will distribute this entire credit by one name, that is IGST. So what I have received is C plus S, but when I'm distributing it to the recipient who's outside my state, I will call it as IGST only. But if I'm distributing it to the recipient within my state, I will call it as C and S. This is a very important point. Keep in mind. Is this okay? Now, for doing the distribution, I need to take the ratio. Ratio is of the turnover, and the turnover should be of the relevant period. Now, what is the relevant period? Relevant period means for working out the above distribution is the previous financial year. If all recipients of credit had turnover in their state during that year. So what is the ratio? The ratio of turnover is the ratio of the previous year. Now, if some or all the recipients did not have turnover in their states during the previous financial year, then the last quarter for which the details of turnover of all the recipients is available prior to the month for which the credit is to be distributed will be taken. So first is, I have to distribute credit. I will take the turnover of the last financial year. Now, if let us say in last financial year, all these units are not present because few units have been started in this financial year, then I will not, or I cannot take the credit of last financial year. Then what I will do is, let us say I have to distribute for the month of December. What I will do is, I will go to the previous quarter and I will take the turnover of the previous quarter, which is available for all these units to whom I have to distribute. And in the ratio of that turnover, I will be distributing. If there are two or more locations of a recipient in a state, union, territory, the sum of their turnovers is to be considered in working out the proportion of credit that will be distributed to that registration. Because a PAN number will have a single registration for all its location within a business vertical in a state, union, territory, etc. Fine. The credit attributable to a recipient is distributed even if such a recipient is unregistered or is making exempt supplies. This is very important. I will not distribute only to those persons who are going to utilize it. I will have to distribute even to that entity which may not be able to utilize. Why? Because it is unregistered or because it is exempt. Because the logic is simple. If I have received a common input service which is for all entities, it means the benefit of this input service is enjoyed by all entities. Then I should divide the credit to all entities irrespective of whether they will be able to utilize it or not. See, they will be able to utilize it depending upon whether their outward supplies are taxable, whether they are registered. If they are not, they cannot utilize the credit which I am distributing. Still, I have to distribute to them as per the ratio. Where both taxable and non-taxable goods are supplied, the turnover excludes central excise, state excise, central sales tax, VAT, etc. So let us say my entities are engaged in supplying GST leviable goods and also non-GST leviable goods like liquor, like petroleum products. Now, when I'm taking turnover, I have to take the total turnover. Again, I will not say I will take only GST related turnover and non-GST turnover. I'll not consider. No. I will take that unit's total turnover. So let us say a particular unit is having turnover of GST items also and of liquor also. I will take total turnover to divide the credit. Is this fine? Now, the formula for distribution of credit is, again, the formula is simple and logical. The formula will be turnover of your state divided by the total turnover multiplied by the common credit. That will be the turnover. So now here C1 means the share which I have to give to state 1. How it will be? It will be T1 in the numerator, which is turnover of that state, divided by capital T, which is turnover of all the entities combined, multiplied by the credit which I have to distribute. So C is the credit to be distributed. T1 is the turnover of the recipient. Capital T is the aggregate turnover of all recipients combined. So it is a simple logical formula. C, the credit which I have to distribute multiplied by turnover of that one unit divided by total turnover of all units combined. Now, some more points you have to keep in mind. First, if ITC is attributable to one recipient, you will give it to that recipient only. Ineligible credit is also to be distributed, fine. Second, if ITC is applicable to more than one recipient, or if ITC is applicable to all recipients, so I will do pro rata distribution. How? ITC to be distributed is equal to turnover of recipient upon total turnover and multiplied by the common credit. And the relevant period is either the last financial year, if not the last quarter prior to the month of distribution for which turnover of all recipients is available. Now, one thing is silent. What if this is the first month? Because a unit has started in this month itself. There is no previous quarter also. Then the answer is, if nothing is mentioned, obviously I have no other choice but then to take the turnover of this month only. So until unless I have a last quarter, I cannot even take this rule. Though this is not expressly mentioned, that is how logically it will be applied. Now, distribution of taxes. ITC of CS in respect of recipient located in the same state will be distributed as CNS only. However, ITC on CNS, where the recipient is located in different state, will be distributed as IGST. This is what I explained earlier also. So when I'm distributing my C plus S credit, if the recipient unit is in my state, I will distribute them by the name C plus S only. But where the recipient is outside my state, I will give them the share, but by the name IGST. And ITC on account of IGST, which I'm having, will be given to both by the name IGST only. This is so because if I give them by the name C plus S, the units outside my state will never be able to utilize it. That is why I give them by the name IGST. Now, some other procedural points that we need to keep in mind. The ISG has to issue an ISG invoice as per Rule 54. It is similar to your regular invoice, but with the only difference, in your regular invoice, you have to mention the outward supply. Here, there is no outward supply. You only mention the credit which you are distributing. It should be clearly indicated in such invoice that it is used only for distribution of ITC. So at the top of the invoice, we call it as invoice, but we write it as only for the purpose of distributing common ITC. The ISG needs to issue a ISG credit note as per Rule 54(1) of the CGST rules for reduction in credit. If credit gets reduced for any reason, the ISG invoice and ISG credit note must contain the following particulars. Again, these particulars are similar to what we study for other invoice and credit notes. So basically, all the points are very similar. So if I have wrongly given higher credit and I want to reduce it, then I will give a credit note in the future month. Relaxation for banks and financial institution. If ISG is a banking company, financial institution, NBFC, the document for distributing credit need not be serially numbered. Okay. ITC available for distribution in a month is to be distributed in the same month. Now, this is very important. I cannot accumulate ITC for 3-4 months and distribute at once. I have to compulsorily do this distribution month on month. So every month, whatever ITC I am getting, whether eligible, ineligible, all ITC I have to distribute in the same month. Details of distribution of credit and all ISD invoices should be furnished by the ISD in their return. And what is the ISD return? It is GSTR 6. Due date is within 13 days from the end of the month. So maybe for GSTR 1, it is 11 days. For GSTR 6, it is 13 days. The details in the returns are made available to the respective recipients in their 2A and 2B. ISD is not required to file annual return. Because anyway, see, ISD is not having any other details. It is having only one detail, inward ITC and distribution of that inward ITC. So there is no need of anything else for the ISD. The ISD cannot accept any invoice on which tax is to be discharged under reverse charge. Now, this is a very big problem, a practical problem. So, ISD may be receiving the lawyer's bill. And obviously, the lawyer will be giving bill to the head office only because his services are for the whole company. But the problem is, when I receive lawyer's bill, which is always to be paid under RCM, the problem is the ISD portal, the ISD functionality does not allow you to pay any tax. Because again, see, we are continuing it from the excise service tax era, where there was no provision for allowing the ISD to make any outward payment because it was a presumption. I am using the word presumption that since this ISD is going to be the head office, there will be no outward supply. But they forgot, and that also the GST law forgot, that ISD may not be having any outward supply, but ISD will definitely require payment option, because if ISD is receiving any inward invoice which is under RCM, that RCM payment has to be done by the recipient, who is over here ISD. But if the ISD functionality is not allowing you to pay outward tax, here the RCM tax, then it is a defect. However, even today, the ISD functionality is the same. Now what they have clarified, that they are not changing the functionality of ISD. So today also, ISD is not able to pay any outward tax liability. So what they have clarified, that ISD, that is the head office, will take two registrations, one regular, one ISD. Now, whenever any such RCM or any such type of invoice will come, you will take it in your regular registration. That is the head office will have two numbers. One is regular number, one is ISD number. Head office will take the credit in the regular registration, that is the invoice in the regular registration, pay the tax under RCM, take the credit in the regular registration, and then shift it to the ISD registration. So since ISD registration cannot pay any outward tax, so this particular point has been clarified in this manner, that you take such RCM invoices in the regular number of the head office, let the regular registration of the head office pay the RCM tax, which it is allowed to do. And after paying the tax, the RCM credit will be shifted by the regular registration to the ISD registration, obviously by fulfilling GSTR1 and all the mechanism. So it is unnecessary increase in the compliance procedure. So this is because the ISD mechanism is only to facilitate distribution of credit. The ISD itself cannot discharge any tax liability like any other person and remit tax to government. If ISD wants to take reverse charge supplies, then in that case, ISD has to take a separate registration as a normal taxpayer. Then issuance of debit and credit note on ISD. So now the suppliers are raising debit credit note on ISD. Now, issue of debit note. The additional ITC on account of issue of debit note to ISD is distributed by the ISD in accordance with the provision discussed above in the month in which such debit note has come. So let us say my supplier gave me invoice. I distributed the credit of the invoice. After 3 months, my supplier realized that he made a mistake. He wanted to charge more tax. So he raised a debit note so that he could correct his previous mistake made in the invoice. Now, whatever debit note I have received, that is giving me more credit. Now in this month, that is a month of receiving this debit note, I will get the ITC on this debit note and I will distribute to you all in the same manner how I distributed the original invoice credit. Next, if I have received a credit note. Now what has happened when I receive a credit note, that is going to reduce my ITC balance. If a credit note is issued to ISD, the ITC to be reduced is also proportionated among the relevant recipients in the same ratio in which the original credit was distributed. Such apportioned credit is reduced from the credit to be distributed in the month in which the credit note is included in GSTR 6. If the apportioned credit exceeds the credit to be distributed, the same is added to the output liability. So what it simply says that I will distribute you the credit note GST in the same ratio in which I had distributed the original invoice GST. So whatever credit note I have received, obviously there is some GST component in the credit note. So I will distribute it to you in the same ratio in which I distributed the original invoice credit. And accordingly, it will go to reduce your ITC balance. This process is also followed in case of reduction of credit already distributed for any other reason. So, same like the credit note logic, let us say 2 months back I had distributed you some ITC, which is pertaining to some invoices which I had received, some input services which I have received. Later on, after 2 months, I realized that I wrongly distributed the credit. Wrong could be for any reason. 1, my calculation was wrong. 2, I distributed a credit which was actually required to be reversed because my supplier did not pay tax or there is some default by the supplier. For any such reason, wherever I need to ask you to reverse the credit, again what I will do is I will give you that particular information by giving you that negative credit balance, and it will be done in the same ratio in which I had transferred you the original invoice. So if the original invoice was transferred 4 months back in the ratio of 1:2:3, so today when I have to give you the credit note for the same invoice, or I want you to reverse the credit of that invoice, I will distribute that amount which I need you to reverse in the same ratio which I had distributed the original invoice. This is what is important point to be kept in mind. Now this increases my working, this increases my burden, because in this month I have to also give you fresh credit for which the ratio may be different. But for this much amount of credit which I want you to reverse, which is pertaining to some previous month, I have to use the previous month's ratio. But that is the ratio which I use in that month. And for the current month fresh credit, I have to use the current month's ratio. So this will create a lot of working. This will also create a lot of challenges in future whenever your audit happens. And the officer may challenge my distribution of credit. Obviously, the officer may claim that the credit which I have distributed is wrongly distributed. So those challenges we will have to face in future. Now, clarification regarding availment of ITC in respect of common input services procured from third party, but attributable to both head office and branches or exclusively to one or more branches. So how this credit has to be distributed, whether it has to be distributed or not, this circular was issued. Now let me inform you, this circular is issued last year only, means recently only, and this circular is issued without considering the amendment. What is the amendment? That now they have made it clear that from 1st April 2025, ISG would be compulsory. But this circular was issued before that. So you will find something in the circular where they may say that this is not compulsory. They are correct, but that is applicable up to 31st of March 25. So the circular, wherever it says it is optional, that is correct up to 31st March 25. From 1st April, that part of this circular will not apply, but the remaining points given in the circular are applicable today also, and even after 1st April 25 also. So what is the issue? Whether head office can claim the ITC in respect of common input service procured from a third party, but attributable to both head office and branch office, or exclusively to one or more branch office, where head office issues tax invoice under section 31 to the said branch office for the said input service, and the branch can then avail the ITC for the same, or whether it is mandatory for HO to follow the ISD mechanism for distribution of ITC in respect of such common input service. Now, what is this question? To understand this question and the answer which is given in the circular, we have to now compare two provisions. ISD, I just explained to you that you are receiving some common input service which you want to distribute to all your branches. That is ISD. However, there is another second provision in the GST law, which is called as cross charge. Now, this word cross charge is nowhere used in the entire GST law, whether the act or the rules or the notifications. However, this word of cross charge has come up as a practice, as a usage. Now, what is cross charge under GST and from where it has come? It has come from Schedule 1, Entry 2. Now, what is Schedule 1? Schedule 1 is deemed supply. That is where the supply is made without consideration. What is Entry 2? Entry 2 is where the supply is made to related persons or the supply is made to distinct persons. Now, here we are only concerned with distinct person. Now, there have been some advanced rulings in GST which highlighted this concept of cross charge. Before that, nobody was much bothered or concerned about the cross charge, neither the taxpayers nor the department. Then there were these rulings, and in these rulings, the advance authority said that you have to compulsorily cross charge. Now, what they said, I'll explain, but I'm just giving you a gist. Then after this ruling, a new dragon came out of its den, which is called as cross charge, which created a new confusion in the industry because this ruling said you have to compulsorily do it. Then further people went into rulings, and different rulings gave different answers. Some said compulsory, some said not compulsory, some said okay, instead of cross charge you do ISD, some said no, you have to do both. Then some said this would be the manner, this would be included, that would be included. So lot of confusion piled up, and then finally last year they had to come up with this circuit. Now, firstly, what is this whole business of cross charge? Schedule 1, Entry 2 says that where one entity gives any goods or services, even though it is giving free to its other entity, which is having same PAN, that is, we both are distinct persons. Here you can understand it from the perspective of head office and branch. Then Schedule 1 is attracted, which says that even though you have not charged anything to that particular entity, but since that entity is your distinct person under GST, you will raise invoice, there will be GST, and the GST has to be paid. Fine. Now, what is cross charge in this? Cross charge is, and now this is what is Schedule 1, Entry 2 saying. Now, what is this concept of cross charge? I am a head office. As a head office, I am providing services to my branches. What is this service? Nobody has understood. But the ruling said that as a head office, you are looking after your branches, you are running those branches, you are managing those branches, you are taking care of those branches. So there is a service flowing from head office to the branch. Now, please understand, students, I personally did not understand the logic of this ruling because, see, I always explain to everyone whenever they have confusion about understanding this cross charge and all, I explain it like this. Like head office is like your parents. You all are the kids of your parents. Now, as parents, it is my moral duty that I have to take care of my children till they all become independent. Maybe even after that, I'll be taking care because you all are my children. That is part of my moral duty, and that is also part of my social, and it is also out of my personal love and affection for you that I will be taking care of. Now, if I am taking care of you, I am guiding you in your life, I am helping you take your decisions, I am doing your caretaking. Am I actually doing a service for you? I personally understand no. Now, the same thing you put in perspective of a company where head office, according to me, is like your parents, and all the branches, all the entities, units of that company are like the kids. Now, as a head office, it is the primary function of the head office to run the company. That is why the head office is. You have the common place where all decision making is done. You have that common place where major accounting is done, where all types of advertisement and planning and forecasting and everything is done. That is what the head office has to do. Branch only has to do their work, whatever. If it is a manufacturing plant, it will do manufacturing. If it is a warehouse, it will do distribution. That's it. That is what is the role of the branches. Now, as a head office, when I'm doing this function of running the whole company, at least personally, I do not find that I am doing any specific service for the branch. However, these rulings, I'll tell you one of the famous names. It is the Columbia Asia. You can check it, Google it, you will find this. So this ruling of Columbia Asia said that no. Head office is supposed to use Schedule 1 Entry 2 and it is supposed to raise an invoice because the head office is actually doing something for the branch. What is this something? As per the Columbia Asia ruling and further few rulings, it said what it is doing. It is this particular function of the head office of managing the company. And when it is managing the company, it is indirectly managing the branch. So managing the branch is the service which the head office is giving or doing for the branch. And this is where Schedule 1 Entry 2 gets triggered. So head office should charge. And this is what has now been called as cross-charged by one entity to another. Now, as I mentioned, because of this advance ruling and then follow-up rulings by different other cases, people went to advance ruling because when one ruling gave something, it created more confusion. And slowly, steadily, as the matter progressed, we started getting divergent rulings. Then came another rule. So firstly, there were rulings about whether cross charge is required or not, if required, how to be done, what ratio, what should be included, what not. Then in between, some person added one more flavor. What is that flavor? Here, wait, head office is also incurring some common expense. And that common expense is for all branches. So for that common expense, you have this option, and it was an option. In fact, it is still an option till 31st March of distributing the ITC of this common expense by the ISD mechanism. Now, what is the new question that these people added? That, okay, wait, you are still disputing about what is cross charge, whether it is compulsory or what will be the amount and all. But new question added was that where head office has incurred common expenses, should it be given by ISD or should it be cross charge? That is, now people started comparing ISD and cross charge, because in cross charge also I will be charging for the common things I am doing for you, and in ISD I will not be charging you any amount, but whatever common input service I have received, I will be dividing the credit. Now again, in this, some ruling said, some department people felt that okay, you can do one thing, for common expenses also you can do cross charge. Some said no, cross charge you cannot do for common expenses, for that you follow ISD. Some said okay, you can do for some part cross charge, some part ISD. Then someone says no, this is compulsory. Someone said no, that is optional. It created a lot of mess. To remove this mess, this circular came as a savior. And I really appreciate the manner in which they have at least tried to resolve majority of this confusion. So what is the confusion, or what is the question? Can head office avail ITC in respect of common input services? So first question is, again, this came because some rulings created this confusion also, that if head office is receiving bill for common service, head office cannot take the credit. Why? Because since it is common service, it is not the service which is used by head office. In fact, there is a possibility that the service is used by only branches. Head office has no role in that service, but the bill is raised on head office. So some rulings, in fact, even said that head office cannot take the credit only in the first place, forget about cross charge and ISD. So the first question came up was that can head office claim credit if it has received some common input service, which may not be even related to the head office, it may be related only to branches. So that is what is asked. So it may be attributable to head office and branch, or it may be exclusively attributable to branch. So it may have no role with the head office. The question was, the first question was, can head office take the credit of such common services. So for this, they have answered in positive that yes, head office can take ITC of such common services. Fine. Then came the second question, where head office issued tax invoice under section 31 to the said branch for the said input service, and the branch can avail the ITC for the same, or whether it is mandatory for head office to follow the ISG mechanism for distribution of ITC. So when it is saying, can the head office raise invoice under section 31? So the question is whether the head office should use the cross-charge mechanism, whereby the head office will charge to its branches, saying that, see, I have done some service for you, I am running you, I am managing you, I am taking care of you, so I am giving you some service. So see, this is the cross-charge as per Schedule 1 Entry 2. Or should the head office distribute this common ITC to you all using the ISG mechanism? So the second question, which was the main confusion created by multiple rulings, that for common expenses, should have head office do cross charge or should head office follow the ISG mechanism? Now remember here, the answer is given before this particular amendment had come, that from 1st April ISG would be compulsory. So this answer is saying that it is optional, but from 1st April, you will not have this option. Whatever common credit services you are receiving, the ITC on such common services, you have to compulsorily distribute using ISG mechanism only. So this option will go. That is the only change in this circular. So what it is answering, it is clarified that in such a case, as per the present provisions, it is not mandatory for the head office to distribute such ISG by the ISG mechanism. This you can simply change by saying that from 1st April, it is compulsory. Where it is saying it is not compulsory, that is correct as on date, but from 1st April, this will change. What it says, so firstly, it is saying as on date, it is not compulsory. Then head office has option either to distribute the ITC in respect of such common expenses by ISD, or to cross charge it by raising invoice under section 31 on the branches in respect of common input services procured from a third party by HO, but attributable to the said branches, and the branch can then avail ITC on the same, subject to fulfilling the conditions of ITC, which is 16 and 17. So here they have answered that head office has the option. But as I'm mentioning, this answer will change from 1st April. From 1st April, for common expenses, you have to compulsorily follow ISD. Then what it says, ISD mechanism can be opted only if the said input services are attributable to the said branch. Okay, this is correct. This will continue later also, that ISD can be used to divide to those branches who are actually benefiting. So if a particular common service is received, which is only for branch A, B, let us say it is cost audit, fees, invoice, and cost audit is applicable only to 3 branches, not to the other 3. So the cost audit expense bill, ITC, will be divided only in the first 3 branches for which cost audit was done. And this bill has come for that cost audit, and it will not be divided to the remaining 3. In case ISG mechanism is opted, head office is required to get itself registered mandatorily. Now this is mandatory from 1st April. Similarly, head office can issue tax invoices under 31 to the concerned branches only if common input service have actually been provided to the concerned branches. Here we can change the language and say that head office will be cross-charging only where head office has done some specific service for the branch. For common expenses, head office will now be doing ISD only. Fine. Now, recovery of excess credit distributed to a recipient. Excess credit distributed can be recovered along with interest only from the recipient and not from ISD. So what is this point? ISD distributed you some credit, and later on it was found that this credit is excess. Excess means I had ITC of 100, but because of wrong calculation, I distributed 1000. So the 900 credit which I have distributed is excess. Now you avail that because I gave you the credit, you utilize it. Now if you have availed and utilized the credit, And later on, it was realized that, okay, this is excess. Excess means I had only 100, but I wrongly distributed 1,000. So obviously what you have to do is you have to reverse that excess 900. And if you have utilized that credit, you will also pay interest, which is logical. So this is what is clarified, that in case excess credit is distributed, see, ISD has distributed, ISD role is over. So they have clarified that whatever reversal is done, whatever interest has to be done, it will be done by the recipient, because logically they have got the benefit of the excess ITC, they have utilized it in their output liability. So they only will reverse and they only will pay the interest. This is all about ISD. Now we come to another part in ITC chapter as to how ITC will be utilized. When we started this chapter, somebody asked me this question, is sir, whether utilization and availment is same? At that time, we were studying section 16, and I had clarified at that time, 16 only deals with availment, that is getting the ITC. After you have got the ITC, how the ITC will be utilized? Now I'll change the word, where it will be utilized, and how IGST ITC, how CGST ITC, how SGST ITC has to be utilized. That is what is given here. Utilization means adjustment against your output liability. That is what is utilization. So availment is first getting the credit. This increases your credit balance. Utilization is adjusting this adjusting this ITC, that is a credit, for paying your output liability. This will reduce the credit balance. Now for this, we originally had section 49, which underwent some amendment. Then later on, you had 49A, you had 49B, and you had Rule 86A. All these were given at different point of time, and slowly, steadily, they started changing the entire utilization mechanism. 86B and all we will study separately because it is for restricting. Now, all these sections and rules ultimately said something which we are going to understand here in a nutshell. Yes. So all these sections, rules, if I have to put it in one table, the table is this. Now, what is this table? Let us understand. I have received ITC. Now, this ITC, what I have received, this ITC may be of IGST, maybe of CGST, maybe of SGST. Now, whenever I'm saying SGST, you have to also remember I'm talking about UTGST, or it may be all of them. Now, assuming I have ITC of IGST, CGST, SGST, all three. Now, in this month, I have to pay my output tax liability. First clarification before I start, you all would be knowing this, that whatever ITC I am having can be utilized by me for paying my output liability. However, I cannot utilize this ITC for paying the liability of RCM. So in any month, wherever I have to pay RCM, I have to pay it in cash ledger only. I cannot set off the RCM liability with my credit balance. Fine. Now, in this month, I have IGST credit, CGST credit, SGST credit. I have all three credits. Now, how to utilize it as per 49, 49A, 49B and the relevant rules? The answer is in this particular table. So left side column is ITC. You have ITC of ICS. And then you have column of output liability of ICS. Now the rule given, I'm giving you the combined effect of all these provisions. Compulsorily, you have to first utilize IGST ITC. So first, you have to take the ITC balance, which you are having under the name, under the category of IGST. So you have to compulsorily use the IGST credit first. And this you have to compulsorily use for adjusting the IGST output liability. So you have to take the IGST credit first, and this credit has to compulsorily be utilized for making payment of IGST output liability. So IGST input credit should be first utilized. Now this is compulsion. First you have to take IGST credit only. So you have to start with IGST credit. First compulsion. Second compulsion, this has to be utilized for paying IGST output tax compulsory. So both these things are compulsory. Now, after you have paid the IGST output liability, let us say this credit is 1,000 rupees. IGST ITC is 1,000. Your IGST output liability is rupees 800. So this 1,000 you are utilizing for first paying the IGST output liability of 800. So it is knocked off. So now your IGST credit remaining after making this liability payment is 200. Now this 200 IGST has to be utilized before you go to the CGST or the SGST credit. So it means compulsorily you have to exhaust, you have to compulsorily utilize your entire IGST credit first. So first utilize IGST credit for IGST liability, that is done. Still IGST credit is left. So in my example, 200 rupees of IGST credit is left. Now they say you have CGST liability also, you have SGST or UTGST liability also. Now you can utilize this 200 for these two in any ratio, in any preference. So this 200 IGST credit I can fully utilize for CGST, or this 200 I can fully utilize for SGST, or 200 I can divide between C and S equally 1/3, 2/3, 1/4, 3/4, 30, 70, 60, 40, 35, 65, any ratio. So here the choice is given to me. So IGST credit first utilize for IGST liability. So this is 1,000, this is 800, I knock off 200 balance left. This 200 I will utilize for paying my C and S liability. That can be done in any manner. Now I utilize this 200 here. So now my IGST credit is over. Now I come to CGST credit. Now in my example, my IGST liability was fully paid. So in my example, this is now 0 IGST liability. What I have to do is this CGST credit, what I am having, I will utilize for paying my CGST output liability. I cannot utilize for making payment of my SGST liability. So C can be utilized for C, not for S. Same thing will happen for S. S can be utilized for S, not for C. Now, if let us say I have my IGST liability also. Now, when this will happen, example, IGST credit was 1,000, original example, but IGST liability was 1,500. Now I utilize this 1,000 for paying off this 1,500. So I utilize this entire 1,000 against this IGST liability, and my IGST liability of 500 is still balance. So in this case, now I am having IGST liability of 500 plus my CNS liability are same. Let us say it is 2,000, 2,000. So IGST liability of 500 and C liability of 2,000, S liability of 2,000. Now, since my IGST credit is over, which is the first rule to first exhaust it, I've exhausted the entire 1,000 rupees. Now I come to CGST. Let us say the balance of CGST is 3,000. This I have to first utilize for paying CGST liability, which is in my example is 2,000. So this 3,000, which I'm having CGST credit, I will first utilize for paying the CGST liability. And after utilizing it, I will come here to pay the IGST liability, which was balance 500. After doing this, I'll come to my SGST credit. Again, SGST credit, I will first utilize for making payment of SGST liability. And after that only, I will utilize it for IGST. This sequence is compulsory. I have to compulsorily follow this order. And this restriction, whatever is said that not permitted, I have to follow the restriction also. This is the combined effect of all the sections that we studied above, along with all the rules. Anybody has any doubts? They have said the same thing in the form of sentences, which you can read from here. I hope this utilization point is clear. If that is clear, I will cover the remaining two rules, so that our entire chapter of ITC will be over. Now, you have rule 86A. What it says? Conditions of use of amount available in electronic credit ledger. Now, actually, it is saying conditions of use. It is actually when the officer can block my electronic credit ledger, or when he can not allow me to utilize the credit. In other words, the officer may block the balance of my credit ledger, because of which I will not be able to utilize it. See, it is given here. May, for reasons to be recorded in writing, not allow debit of an amount equivalent to such credit in the electronic credit ledger for discharge of any liability. In other words, this rule empowers the officer to block my credit ledger. It is like freezing my credit balance. So even though I can see the balance in my credit ledger, I will not be able to utilize it. And this will be done or can be done by the officer from his portal. Now, when he will do it, the answer is this. Conditions for use. What it says, the credit of input has been availed on the strength of tax invoices, debit note, or any other documents issued by a registered person who has been found non-existent or not to be conducting any business from any place. So first, when he can block my credit ledger, if my ITC is taken from such a supplier who is now not existent or who is not conducting any business. Second, without receipt of goods or service, that is, it is a fake invoice. I actually did not receive anything. I only took a fake bill from some supplier, and on the basis of fake bill, I have taken the fake ITC. So first two scenarios is where the supplier from whom I have received this GST credit is non-existing, or second, the good service which I am saying that I have received is actually not received, means I have a fake invoice. Third, the credit of input tax has been availed on the strength of tax invoice or debit note or any other document prescribed under 36 in respect of any supply, the tax charge in respect of which has not been paid. So in this third scenario, which is in clause B, my supplier is existing. So there is no problem with the existence of supplier. Second, the supply is also genuine. I have actually received the good service. So first two problem is not there. But there is a new problem that my supplier has not deposited the tax with government. So there is a risk that the supplier may run away and he may be a defaulter. Fourth, the registered person, that is me, availing the credit of input tax has been found non-existent or not to be conducting any business from any place for which registration has been obtained. So I am also not existing. That is, I have fled. If somebody comes to my premises, they find that there is no business working from here. It means I am a dummy registered person. So they may block my credit ledger. The registered person availing any credit of input tax is not in possession of tax invoice or debit note. Now here, I am saying that I have received good service, but I am not having the documents. If I am not having the documents, again, my credit can be blocked. Now here, what the rule says, the commissioner or the officers authorized by him under sub-rule 1, what we studied, upon being satisfied that the condition for disallowing debit of credit ledger, that is for utilizing your credit ledger. Debit means what? Utilization no longer exists, allow such debit. So sub-rule 2 says that after blocking the credit ledger, afterwards, once the above problems are solved, you give them the proofs that above problems are solved, they will remove the blockage. So now you can debit it, that is, you can utilize it. Such restrictions shall cease to have effect after expiry of period of 1 year. And third point says, whenever you blocked my ledger in sub-rule 1, After 1 year, automatically the blocking will cease. That is, I will be able to utilize it. In other words, the blocking remains for 1 year compulsory. After that, it will automatically be released. Next, 86B, restriction on use of amount available in credit ledger. In fact, 86A is also restriction. In fact, it is blocking. 86B is restricting. Now, what is 86B saying? Now, it is a strange rule according to me. I did not find any logic in this rule. This rule says that even if you are having sufficient credit balance, you can utilize maximum 9%. Sorry, not 9. You can utilize maximum 99% to pay the output tax liability. It means 1% of output tax liability has to be paid by cash ledger. I find no sense, no logic to this rule 86B. Correct? But somehow this is how the rule is. So what this rule says? Notwithstanding anything contained in these rules, the registered person shall not use the amount available in credit ledger to discharge his liability towards output tax in excess of 99% of such liability. In other words, you can pay the liability up to 99% from the credit ledger, assuming you have a lot of surplus balance. Still, 99% only you can pay through the credit ledger. Balance 1% of your liability you have to compulsorily pay using cash ledger. That is what they are saying. In cases where the value of taxable supply other than exempt supply and zero rated supply in a month exceeds 50 lakhs. So this is in short applicable to big taxpayers whose value of supply in a month is more than 50 lakhs. So somewhere for big taxpayers, they have made a restriction of utilizing the credit balance. Fine. However, they have given relaxation also. What it says, provided that the said restriction shall not apply. It means you can utilize full credit ledger and you can pay the entire liability using credit balance where the said person or the proprietor or karta or managing director or any of its two partners, whole-time directors, member of managing committee of association, board of trustee as the case may be, have paid more than 1 lakh rupees as income tax under the Income Tax Act in each of the last 2 financial years for which the time limit to file return has expired. So they are going to check your credibility. If your credibility is proved, then above restriction is not applicable. How your credibility is tested? So in case of proprietorship, the proprietor, in case of HUF, the karta, and in case of company, the directors, in case of firm, the partners, their income tax returns would be checked. And if these people in their immediate past 2 returns have paid income tax of more than 1 lakh rupees, it means you are a credible person. Since you are paying income tax of more than 1 lakh, so you are a credible person. You will not apply this restriction. Second, the registered person has received a refund of more than 1 lakh in the preceding financial year. So another test of my credibility is, in the last year, under GST, I have got a refund of more than 1 lakh on account of unutilized ITC. Now, why or how this will test my credibility? Because if I have got so much of refund, and this refund I will be getting by making an application, the department will check my application, and only if it is correct, it will pass. So automatically the department has been checking my records. It means my credibility is proved. Third, the registered person has received a refund of more than 1 lakh in respect of financial year, preceding financial year on account of unutilized ITC under this clause. So it is both same. The difference is only of clause. So one is for export, one is for your unutilized ITC on account of inverted duty structure. Next, registered person has discharged his liability towards output tax through cash ledger of an amount which is in excess of 1% of the total output tax applied cumulatively up to the said month in the current financial year. So what it says, the fourth way of testing my credibility is that whatever tax I have paid, so I have discharged my liability towards output tax, and how I have discharged it, using my cash ledger, and it is for an amount which is in excess of 1%. So I have paid my output tax exceeding 1%, and how I have paid? Using the cash ledger of the total output tax liability applied cumulatively up to the said month in the current financial year. In short, in past months, let us say now we are in December. So for all months from April to November, whatever was my total cash liability, total tax liability, out of that total, find out 1%. If till date, I have already made that payment of 1%, no problem. In the next month, I can pay the whole amount using credit ledger. Or last, the registered person is government, PSU, local authority, statutory body. So anyways, they are credible. There is no problem. Provided further that the commissioner or an officer authorized by him in this behalf may remove the said restriction after such verification and safeguards as he may deem fit. So 86B puts a restriction that if I am a big assessee having a monthly turnover of more than 50 lakhs of taxable supplies, I should utilize my credit ledger only up to 99% of my output tax liability, and 1% I should pay in cash. This restriction will not apply where my credibility is proved. So these are the two restrictions in the form of 86A, where they can block my credit wherever they are doubtful about me taking correct credit or utilizing correct credit or my supplier being genuine. Then they can block my credit ledger. That can be maximum for 1 year. And in 86B, every month I have to check my status. And if I'm fitting in the credible category, no problem. If I'm not fitting in the credible category, then that month's outward tax, 99% I can use my credit ledger. For balance 1% of my output tax, I have to compulsorily pay using cash ledger. So this is what is the whole provision. I've explained you all these points with all the exceptions and the conditions. And I believe this is the end of this topic. Yes. Now, since we have completed everything of this topic, I request you all once again to please study the whole chapter, including what we discussed in the previous lectures and what we completed today. Study it whole, and we will engage whatever doubts you have relating to this in our next session. Is it okay with all?
Sir, when is our next session?
Why is this question, beta?
Sir, in a schedule after 31st December, there is no schedule of lectures.
But then I'll check. I think you'll be updated the next schedule. I also don't know. I'll have to check the schedule with BOS. I think it should happen immediately in the next week. But let's see. I'm also not sure. I'll just check with BOS. So it will happen on the respective dates. Maybe the topics they are yet to assign. I'll also check with them. But you'll get it immediately in the next week. So our lectures are on Thursday and Saturdays, no? So by Monday, Tuesday, you'll get the schedule for the next month.
Okay, sir.
Fine. So that's it all from my side. Thank you very much. Let us connect soon for the further topics.
Thank you,
Bye-bye.
sir. Good.
Good night.
Thank you, sir.
Yes. Good night, everyone.